Secretary of the branch, CA Prashant Kumar. Learned speaker of today's session, CA Dr. Venkatesh Garu. Senior members of the profession, respected past chairman, members of the managing committee, my dear professional colleagues, a very good evening to you all and welcome you all to this virtual seminar of today's topic, capital gains relating to NRIs and others. We, the members of Visakhapatnam branch, convey our heartfelt thanks to the speaker, CA Dr. Venkatesh Garu, for accepting our request to address the members of Visakhapatnam branch. Due to his busy schedule, though we are trying for his appointment since June month onwards for his session, finally we could get by now. So thank you very much, sir. There is a lot of confusion about tax implication for NRIs with regard to capital gains, who want to sell any house property they have in India, how much capital gain tax is payable, whether it is short term or long term capital gain, and how much TDS is to be deducted. Are the exemptions under section 54 are available to NRIs or not? What are all the implications when NRIs giving their property for development, so on and so forth. Similarly, the tax implications on long-term or short-term capital gains on sale of shares and securities, speculative and non-speculative, there's many issues. Further, relief from double taxation. The non-resident can take relief from double taxation if India has signed the double taxation avoidance agreement with the country of his residence as per the treaty. The NRIs can pay tax at either of the countries or pay the tax in both the countries and claim tax relief in the country of their residence. Issues under section 50C, carry forward and set off losses and many more updates. To explain all these and many other issues involved in capital gains in context of NRIs and other critical issues, we have a renowned speaker, CA Dr. Venkatesh Garu with us today. Members, one important announcement. Tomorrow we have programs at our branch premises on the occasion of 75th Independence Day. By 9 a.m., flag hoisting will be there, followed by breakfast. And by 11:30 a.m., we are distributing food, masks, and sanitizers to the inmates of St. Joseph's Old Age Home as a CSR activity. I request the members to join for all the programs of tomorrow. Now I request Vice Chairman of our branch, CA Vasudev Murthy Garu, to introduce the speaker of today's webinar.
Thank you, Chairman Garu. I am pleased to introduce our beloved Dr. Venkatesh Garu. Sir, Dr. Venkatesh Garu born in an agriculture family in Bommanani village and Chitradurga Taluk and district and Karnataka state. Dr. Venkatesh is a commerce graduate from Mysore University and a law graduate from the Bangalore University. He has done his articleship in MSSSV and Company, Chartered Accounts Bangalore, and is practicing a chartered accountant from the year 1986 and membership number 25087 in the same forum. After his qualification, he joined as a partner MSSSV Chartered Accountants, a well-reputed firm in Bangalore. MSSSV and Company Chartered Accountants was formed in the year 1981 and has made remarkable progress in the field of chartered accountancy. Dr. Dr. Venkatesh is a tax consultant for many leading cooperative banks in Karnataka. He has made remarkable achievements in the branches in that field. For example, taxation in cooperative banks, taxation of non-profit institutions, and a tax reduction at source, tax audit, servant section Caesar. Really, he has received so many recognitions, but some of the recognition, just I am quoting just as examples, because he has received so many recognitions. He was the president of the Karnataka State Chartered Accountants Association in the year 1998-99, because the Karnataka state is the only state is maintaining the state level organization as a professional chartered accountants organization. He was the chairman of All India Federation of the Tax Practitioners. He is a resource person for the so many organizations, and as well as the branches of the Institute of Chartered Accountants of India, especially in the Karnataka state. All India Federation of the Tax Practitioners and also professional associations. He has addressed teleconferences at New Delhi in a tax-related source from our institute. With this brief introduction, I am introducing Sri D.R. Venkatesh for the August gathering. I welcome him for this excellent topic chosen by our chairman. So, Venkatesh Garu, now I welcome you to take up this subject. Thank you, sir.
Thank you.
Thank you, Vasudhamurthy Garu. Now I request the speaker, CADR Venkatesh Garu, to take up the session.
Thank you, sir. I can speak to the time.
Members who have
Once
circulated the
again.
PPT of today's speaker, CADR Venkatesh Garu, to your mail as well as to WhatsApp. The PPT was circulated to you, so you can view
Watch.
in your devices also as well as this. Please, sir, proceed, sir, please.
Friends, I'm very grateful to the Visakhapatnam branch of SARC for giving the opportunity to read these provisions of the capital gain issues. Friends, when Sharma called me earlier, also maybe in the month of June, they called me for the one of the program, but I told it's very difficult because that time was a Bangalore is full lockdown. I didn't accept the invitation. I was feeling little bad. When Sharma called, I told yes, I only date was this one. They give me two options, 7th and 14th. I told I agree for the 14th. And also topic also I didn't have it. They told capital gain, fine. I'll give it because otherwise every time they used to call for Visakhapatnam only for the TDS, tax deduction source. This time I'm very happy that you have given a different topic, which I, sir, I want to go through these provisions of capital gain and other related issues very detailedly, very interactive. And I request all the participants to note down the thing, and I'll stop maybe after 15-20 slides, and I'll ask you any of your views is there or you want to ask any questions. I'll request you to get questions from the participant. This is what I want to proceed. Friends, I want to tell you, with me, my friend Sandeep is there. He is my partner. He is going to take up the issue connected to non-residents. He is also very well versed in the tax provisions. He is the person who is heading the litigation department in my office. He is going to take up the issues connected to non-resident. I am taking other issues. So the 3 hours you have allotted me, in the 3 hours you want to see that everybody will enjoy the discussion. This is what think what we have planned for the day. Friends, in the 3 hours, we want to discuss sir, I want to discuss today in 3 hours the introduction. What is this capital gain? What are this? You know it, but just I want to. After that, I want to discuss some of the basic thing you should know while dealing with the capital gain chapter. Therefore, that I'll deal. Then how to compute the capital gain, that you know it, but I want to refresh your memory and I'll tell how you have to compute. Indexation, tax rates. Thereby, chairman has told very clearly. Actually, chairman in the beginning, he has given a full syllabus for the today's discussion. He has given very detailed syllabus for the today's discussion. I am very happy that we are going to cover all the issues, whatever we mentioned by the chairman. Tax rates for resident, non-resident, individual, others. Then exemption and deductions available under head capital gain, 54, 54 EC, 54B, 54 F, all these exemption we are going to discuss. What are the conditions, what are the eligible, who are entitled, what is the exemption. Next, after that, friends, I am going to discuss the set off and carry forward of the capital gain laws, and I am going to discuss something about the section 50C, what are the issues. Friends, finally, I have selected around 53 questions or practical questions which I want to give some case laws, and what are they are very interesting case laws, interesting issues, so that when I discuss critical issues, I think all the questions you are likely thinking in your mind and capital gains will be covered at that time. And in non-resident, we have 8 issues. Totally, we have some around 61 issues in the critical issues session, and we are going to take up all these issues one by one. Friends, this is the guidelines in which we are going to start. Kindly note what we are discussing, what we are mentioning related to assessment year 21-22, or the what is introduced in the Finance Act 2021. It is applicable from 2022 also. We are going to cover up. This is the guidelines. Anybody is having any issues for the earlier year, please raise it. We'll try to give our views on that issues. Friend, with this, we'll start the discussion. Friends, all of you know, under the Income Tax Act, Chapter 4 deals with the heads of income. Chapter 4 of the Income Tax Act deals with the computation of the total income. In that, what the section 4 says, heads of income. Salaries, income of most property, profits and gains and profession, capital gain, and income of other sources. Today, our discussion is only on the capital gain, income assessed under the head capital gain, short term or long term, that we are going to discuss in this chapter. All other issues already Chairman told we have covered 45.4, you have covered so many issues. I am going to cover only the capital gain. Friends, actually, under the 1961 Act, Section 45 to 55A covers the capital gain. We have only 30 sections, but in 30 sections, you can discuss for 3 days. So many issues are there, but I have today, within 3 hours, I want to try to see that all the participants are aware of the issues involved in the capital, under the head capital gain. I again want to give you some background of this capital gain. Earlier, capital gain charged income tax, first time in the India from assessment year 1947-48. This is so many years old. I was taxed from assessment year to 1947 to 48. First, it is called as Income Tax and Excess Profit Tax Amendment Act 1947. Under Section 12B of the 1922 Act, it was assessed as capital gain. In the Finance Act number 3 of the 1956 is revised, Section 12B, with effect from 1st April 1956 onwards, they changed it. As you know, in 1961, they recasted the Full Income Tax Act, and now in the Section 45 to 55 deals with the capital gain. This is the background of this. Now we have to know some of the definitions of to deal with or to understand the capital gain very clearly. Chairman told in the beginning, short term, long term, all these things which I have done. First, you should know, you want to assess under the head capital gain, that should be a capital asset. First basic condition is, what is to be assessed in this head is, any gain arise on not capital asset. Any gain arise out of the capital gain, sale of a transfer of a capital asset will be subject to under the head capital gain. Therefore, you should know what is a capital asset. That is defined in Section 2, subclass 14. Capital asset means property of any kind held by assessee, whether or not connected to business or profession. Whether it is connected or not, it may be connected to person also, it is called a capital asset. This is the property of any kind. This is a very important definition. Next is any securities held by a foreign institution, investor, which has invested in such a securities in accordance with the Securities CPE Act. After any unit of insurance policy which the exemption under class 10D of 1010D does not take in account of the applicability of the 4th and 5th provision thereto. It means for a definition of a capital asset, you should very clearly for all practitioners is property of any kind, whether it is a business asset or is a personal asset, will be liable for, is called as a capital asset and is liable for capital gain tax. But the personal assets, some of the assets which are exempt from capital asset, the definition is stock in trade of a business associate or other than securities held in the subclass B of the above act, consumable stores, stock in trade of any nature, whether raw material, finished goods, all is included, consumable stores, raw materials, held for the purpose of business or a profession. It is outside the definition of a capital asset. It means any sale of a raw material or any sale of a asset, inventory, it is treated as a business profit, it cannot be treated as a capital. That is what they want to say. Personal effects are also outside the definition of capital asset. But the personal effects are outside it, but following are the personal effects, even though it's a personal effects, but is liable for capital gain tax because jewelry, article collection, drawings, paintings, sculptures, any kind will be subject to, is treated as a, even though it is treated as a personal asset, but is liable for capital gain tax because it's a capital asset. This is what you want to understand. Next is, friends, you should know what is the meaning of long-term capital asset. Long-term capital asset as defined in section 2 subclause 29AA means a capital asset which is not a short-term. Very, very easy. Long-term capital asset means a capital asset which is not a short-term capital asset. It means, but you should know what is short-term capital is later. I'll take up later. Then long-term capital gain means defined section 2 subclause 29B. It says a capital gain arising from a transfer of a long-term capital asset. It means any gain arises on account of transfer of a long-term capital asset is called long-term capital gain. 242A now define what is a short-term capital asset. I told you long-term capital asset means is a capital asset which is not a short-term capital asset. Under capital asset, short-term and long-term. Long-term is defined very easy, saying that whichever is not short-term is long-term. For that, you define what is short-term means. A capital asset held by assessee for not more than 36 months immediately preceding previous year, preceding date of transfer. At the time of transfer, you are holding this asset more than 36 months, then it is called as a, if it is more than 36 months, it is called long term. If you are holding less than 36 months, it's called short term. Therefore, it is defined as short term, means is less than 36 months is the general assets. But you have the other assets which are treated in case of a leases securities, that is a 12 months period, 12 months period, zero coupon bonds, 12 months period, holding period is less than 12 months, short term, more than 12 months, long term. In case of unlisted shares or immovable property, unlisted shares or immovable property, that is being the land or a building or both, period of 24 months. Earlier was 36 months, it was modified to now 24 months from 2017 onward. It means that to know what is the long term, it means you have to hold more than this time schedule. If it is holding more than that, then it will be treated as a long term. Therefore, you should know through subclause 42A to know the short term capital gain. Once it is not a short term capital, it is automatically long term capital asset. Section 242B, short term capital gain is very simple, means a capital gain arising from a transfer of a short term capital asset. It means that now in a capital gain, we have two types of gains, short term capital gain or long term capital gain, or from immovable property or other assets. It will be assessed under the head capital gain, short term or long term. Now very clear, short term is you are holding less than the prescribed time schedule, then it is short term. If you are holding more than that period, is called long term. Any gain arises from the sale of a or a transfer of a short term capital asset, it is short term capital gain, or any gain arises on account of a transfer of a long term capital asset is called long term capital gain. This is what the basic thing you should aware when you are discussing all the issues connected to the capital gain. Next is 242C. In this capital gain, we have a slump sale definition. Suppose any person, I'm not taking the definition, I'll give some example. Now, any business undertaking, you want to transfer as it is. All the assets and all the liabilities together, you take a consideration of X figure. It is called sum sale. It is also liable for capital gain only. It is also liable for capital gain, but indexation is not there. But you have to ascertain the cost and other is defined in this. It means that sum sale means a transfer of a one or more undertaking by any means for a lump sum consideration without values being assigned to the individual assets or liabilities of such sales. It means that sum sale means you are not going to fix any value for the assets or value for liability. All together as a business as it is, one undertaking, I am giving you 100 lakhs. That is the slump sale. It is a slump sale. Therefore, there is no question of any value assigned to each asset. Therefore, this should be treated as how it will be dealt in the next slides. I am going to explain. These are the basic things, friends, you should know. Next, very important is transfer. For a capital gain arises, it should be a basic condition should be a transfer of an asset, capital asset. Transfer definition is defined here, it includes sale, exchange, enrichment of the asset. Everybody know this definition, I am not going to take. Extinguishment of any right thereon, compulsory acquisition thereof under any law. In case of where the asset is converted by a owner thereinto or treated by him as a stock in trade of the business carried on by him, such conversion or treatment is also treated as a transfer. Maturity or redemption of zero coupon bonds also treated as a transfer. It means transfer definition is very clear. Sale, exchange, or relinquishment of any asset is a transfer. Like that, they define all the clauses and which covered definition of transfer. After that, very important, as a consultant should know, any transaction involving allowing a possession of an immovable property to be taken or retained part purpose of the contract returns referred in 53 of the Transfer of Property Act. This is very important. Possession of handing over the property, even though you are not registered as sale deed, but you are entered into agreement, but you handed over the possession to the buyer, then automatically amounts to a transfer. Then your capital gain arises in the year of giving a possession to the buyer. Therefore, you are not necessarily wait for the sale deed execution before the authorities. That is not the criteria. But for the purpose of this transfer, even if you hand over the possession to the buyer, after and it fit into the definition of Section 53A of the Transfer of Property Act, then it is amounts to a transfer that will be subject to capital gain tax. Next is any transaction, whether way of becoming a member or a acquisition of shares and in a cooperative society or a company, other association of person by way of any agreement or any arrangement or in any other manner, which is the effect of transferring, enabling the enjoyment of immovable property, also is almost a transfer. This is very important in some cooperative societies, especially in Bombay, in Maharashtra. This is a ruling this one, where nobody registers the property. They buy the shares of a cooperative society. After buying some certain specified number of shares, they get so much area. It means for buying the shares, you get the immovable property as per that act, Cooperative Society Act or Societies Act. Therefore, this type of transaction also will be considered as a transfer for the purpose of, because you are giving enjoyment of an immovable property later, that is also subject to the amounts to a transfer. Next is how to compute the capital gain. This is a very interesting thing. All of you know capital gain to be computed as per Section 48 of the Income Tax Act. It says very clearly, it says sale consideration received as per the agreement or as per the contract or as per the sale deed executed to the sub-register office or the register authority. What is the consideration received? What are the expenses you can reduce from that consideration? This is very important. Consideration, you take it from the sale agreement or the sale contract or a sale deed executed by the authorities. That is a consideration mentioned in the agreement. And you know the result, transfer is there, everything is there. Now, what are the expenditure claim is? One is expenditure incurred wholly and exclusively in connection with such transfer. It means you have incurred any expenditure for the purpose of transferring that asset. You have incurred expenditure, maybe lawyer fees or a commission paid to the broker. That all you can produce from the sale consideration you can produce. Next, very important is cost of an asset or a cost of an improvement. These two expenses can be deducted. It means cost of asset, what you have incurred, and cost of any improvement there too. You have incurred any cost for improvement of an asset, that also can be. It means that from a sale consideration, you can reduce the expenditure connected to sale, one. Number two, the cost of acquisition. Next is cost of improvement. These are the three things you can consider as a deductions available to the capital gain thing. After that, this is section 45(4). Actually, Chairman sir told me very clearly, 45 subclass 4 was exhaustively discussed by the speaker earlier occasion. You have a very verbose with this provision. Therefore, I will not take subsection 45 for time being, because it is related to the capital gain arising of any retirement or any arrangement between the partners. This 45 subclass 4, it is introduced from the last year. Therefore, I am not going to take up because already covered in the earlier sessions. Now I will take up one thing. Now is important is, cost of acquisition, cost of improvement. Now the issue is indexation. The indexation is very clear rules. What it says is the index cost of acquisition means amount which bears to the cost of acquisition the same proportion as the cost of inflation for the year in which asset was transferred, bears to the cost of inflation index for the first year in which the asset was held by the assessee for the year beginning from 1st April 2000, 1981 up to assessment is 1718. Now is 1st April 2001. This is the date. It means that now you have a question. If you have acquired the asset, any time before 1/4/2021, law gives you, 2001, law gives you to take base year is a 1/4/2001. What is, suppose you have purchased in, take around 1995. That time you have paid 10 lakhs rupees. But you have to ascertain what is the fair market value as on 1st April 2001. That value is the cost of acquisition. Is deemed to be the cost of acquisition for that 2001 and index from that year. Indexation very simple, no problem. Index number is already notified, and this is the index number. You have to, index number is cost of acquisition divided by the year in which you have purchased that index number, or 2001 index number. You multiply by the year in which you have sold. What is the index number that you have? That is gives you index cost of acquisition. Similarly, index cost of improvement. Anything you have done improvement later after purchases, you have incurred any expenditure from the year of expenditure up to the year of sale. What is the index number? Accordingly, index the improvement cost. It means from the your sale condition, you reduce the index cost of acquisition. First, you reduce the expenditure connected to the transfer. Then, second, you reduce the index cost of acquisition, index cost of improvement. These are the three deductions available from the sale consideration received by the assessee. I have given the formula. Suppose mode A, where asset was purchased by the assessee. Assessee himself has purchased the property. Then cost of acquisition divided by the cost of index for the year of transfer divided by cost of acquisition for the acquisition in the year of acquisition. What is the cost of index number in the year of acquisition? Suppose the year of acquisition earlier to 2001, 1st April 2001, then you have to take the base year is, that is 100. Cost of acquisition into what is the year in which you have sold divided by 100. That gives you index cost of acquisition. If you have purchased earlier to 2000, if you have purchased later, year of when you have purchased, that what is the index number that you do it and calculate. This is very simple. But next is asset acquired described under 49.1. That is a 49.1 is will gift. You have received a gift from your blood relatives. You received a gift from your parents, or by will you have received it, but you subsequently sell it. Subsequently, you want to sell that asset. Law is very clear. Then period of holding will be considered even what the previous owner is holding. Suppose, take for example, Mr. B is receiving the gift property from his father, Mr. A. Father is already holding the asset. Purpose of this capital gain tax, year of number of years holding to in the hands of B is should be 15 years, because what are the holding by Mr. A earlier donor will be considered as a holding of the this donee and will be calculated index cost of acquisition accordingly. Therefore, only thing is here you have to see whether a mode of acquisition is will or a gift. Then what is the period of holding of the donor who has gifted or who has willed it? What is the his holding period? Accordingly, you have to calculate cost of indexation of this property transfer under 49.1. That is a will or a gift, donor, gift, will. In following cases, the indexation is not allowed. The very important is in the following cases, indexation of cost or indexation of report not allowed. What is this? Transfer of capital is being a bond or a debenture. Other than that, this transfer of long-term capital being a bond or a debenture, no indexation is permitted. But capital indexed bonds, these are all indexed bonds, there will be indexation possible. Sovereign gold bonds issued by Reserve Bank of India, indexation is permitted. Transfer of shares or debentures acquired by a non-resident in a foreign currency in Indian company, indexation is not permitted. Very kindly note, transfer of a shares or a debentures acquired by a non-resident in a foreign currency. If acquired in an Indian currency, indexation is permitted. Acquired in a foreign currency, indexation is not permitted. Transfer of unlisted securities by a non-resident. Any non-resident acquires any unlisted securities like a private company and other thing, non-resident indexation is not permitted. Whether it is Indian currency or foreign currency, there is no distinction. Capital gain arising from transfer of long-term asset being any equity shares in Indian company, indexation not permitted. Unit of a unit-oriented fund not permitted. Units of a business trust, indexation not permitted. On which the STT is paid, security transaction is paid, then indexation is not permitted. Transfer of an undertaking or a division lump sum. I told you earlier, section 242A gives a definition of some state. In that, there is no question of any indexation is permitted. Asset-wise, tax, land indexate, building indexate, or a plant and machinery indexate is not permitted. When you want to come under section 2 subclass 42A some sale, the indexation is not permitted. This is very important. Similarly, any units of 1023D, there also indexation is not. Like that, they given a lot of list of assets which you want to transfer. Indexation is not permissible. Indexation not allowed. That you can please read these are all connected to foreign exchange thing and foreign exchange asset, which my friend is going to deal with. That indexation is not allowed. Kindly note, indexation in majority of the non-resident cases is not permissible. Index cost of improvement already explained to you that any improvement is there after the asset is purchased, that you can index it up to the date year of sale and claim it as a deduction. Now, very important is tax rates. Friends, you know how to compute, you have computed. Now you have to think which tax rate you have, not in the normal rate of tax. Friends, kindly note is not normal rate of tax applicable to individual, but is a different rates. Take for example, any resident or a non-resident having any long-term capital gain arising from listed securities or a zero coupon bonds, 10% without indexation. Rate of tax is, you don't want to do indexation, 10% is the rate, but you want to do indexation, 20%. It is an option. Non-resident indexation is not possible. Resident indexation is possible. Subject to whichever the option you want to do it, you do it. Whether 10% without indexation, 20% with indexation. But you have to work out for assessing whether if you're taking indexation, whether beneficial or not. If it is beneficial, then you take indexation. Otherwise, apply 10 or 20% accordingly calculated tax liability. Similarly, under non-resident or a foreign company, this is applicable only to a non-resident, obviously individual. Then non-resident or a foreign company, long-term capital gain, unlisted shares or the securities, 10% without giving effect to the first proviso and second proviso to section 48. What is this section 48? Section 48 gives to the non-resident, if he has acquired asset in a foreign currency, he has acquired a shares or a securities in a foreign currency, he can convert into that when he sell in the year of sale, he can convert into foreign exchange and work out the tax liability and the capital gain. But if you are not interested in converting to foreign currency, you want to do it in INR only, that is the case, you can do non-resident or a foreign company, but the unlisted shares, listed you don't option, you have to go for the indexation or not, without indexation, 10% is the rate. But you want to do that, then again you have to go to the earlier part. Then long-term capital gain on any other capital asset. Kindly note, resident or non-resident sells any property, any asset other than shares and unlisted shares or listed shares like immovable property, then rate of tax is 20%. Rate of tax is 20%. Kindly note, this is a basic rate. Surcharge is applicable. Education cess is applicable extra. This is only basic rate. Apart from that, it depends upon your limit, depends upon your income. Surcharge is applicable. Education says any of 4% is applicable on the total tax liability, including surcharge. This is the in respect of tax rate. After 111A, resident or non-resident, any short-term capital gain, as per the definition of the short-term term, arising from equity shares or units of equity-oriented fund or a unit of business trust, then rate of tax is 15%. 15% is the rate of tax. 112A section gives you whether resident or non-resident, long-term capital gain in respect of equity shares or a unit of a fund, units of business trust, then 10% in excess of rupees 1 lakh. It is what one up to 1 lakh is a basic exempt. After that, 1 lakh, 10% is the tax rate applicable to the resident or non-resident arising from equity shares. Resident or non-resident, any short-term capital gain, any other capital asset, normal rate of tax. Long-term capital gain, 20%. But short-term capital gain arising from a immovable property or the listed shares or unlisted shares will be taxed at a normal rate of tax. Normal rate of tax is individual up to 5 lakhs, no tax, 5 to 10 lakhs. Oh, sorry, up to 3 lakhs, no tax, 3 to 5 is 5%, 5 lakhs to 10 lakhs is 20%, more than 10 lakhs is 30%. That rate is applicable in case of a short-term capital gain, whether resident or non-resident, rate, normal rate of tax is applicable to the individual. Now I come to friends, section 50C. Our chairman has specifically mentioned, please cover this section 50C. What is this section 50C is? For the purpose of taxation, deemed some of things as a consideration. Even though you are not received that much, you will be deemed as a consideration. What it says, in case of immovable property, under 43CA, in case of a business asset, like a building or something of a developer, you sell the property and you go for registration to the sub-registrar office or to the authorities competent. When you go there is a very standard rate on all governments, they fixed what is the rate that's called guidance value for all the immovable property in a particular city or a particular city area, again, sub-unit area. Take for example, in Visakhapatnam, the SR value for a particular area, only is an example, I'm not telling, 10,000 rupees per feet. In Visakhapatnam, much more, but I'm just giving example, 10,000. But value is 10,000 rupees per feet. But I am entering into an agreement to buy a property. Actually, consideration is only 8,000 rupees. 8,000 rupees is the consideration. In the sale deed, buyer and seller both agreed to give 8,000 rupees. But fair market value, as per the government rules, SR value, that is 10,000. The section 50C of the Income Tax Act, it says that when you buy a property and the consideration paid or mentioned in the sale deed is less than the fair market value fixed by the authority, stamp duty authority, because stamp duty purpose, there will be a fair market value for all the property per square feet or a cent basis, it is there at that. Suppose your consideration is less than the fair market value for the purpose of stamp duty value, law presumes that stamp duty value will be the consideration purpose of section 50C. Accordingly, you have to work out the capital gain in the hands of the seller. It means now the example is, suppose I sold 10,000 square feet of area at 8,000 rupees. I received 80 lakhs rupees. But for the purpose of stamp duty, I will pay 1 crore. I paid 20 lakhs extra. On 20 lakhs extra, I paid stamp duty. This is the facts of the case. And you are not disputed. You are not disputed because these are all very lengthy procedure. You have agreed to pay stamp duty. Now the income tax, when it comes to income tax law, the income tax authorities will say it's based on the sale deed. They say that you have paid stamp duty on the 1 crore. Therefore, the purpose of capital gain tax in the hands of the seller, I will take it as 1 crore. I will take it as 1 crore is the sale consideration. I'll work out accordingly other things and I'll tax you capital gain on 1 crore, not on 80 lakhs. Even though actually you received only 80 lakhs. But the purpose of taxation, 1 crore is the stamp duty value to be considered under section 50. That is the very important. A fiction created in section 50C that you deem to have received the value as per stamp duty valuation. That is the fiction. Section 50C is created. Similarly, under 43CA also created that is a deemed fiction that it will be your receive consideration as per the stamp duty valuation. This is the one of the problems we are having. I am going to discuss some of the 2-3 problems on this stamp duty valuation. I am going to discuss. But now the only thing is, take for example, and my given example, actually consideration is 80 lakhs, but stamp duty value is 1 crore. Now the officer want to take 1 crore for the taxation. Fine. If we treat as a capital gain, I'll pay 20%. But very peculiar now, the officer says, no, 80 lakhs I'll treat as a capital gain because you have mentioned in the sale deed. I'll come work out the tax liability for 80 lakhs under the capital gain. What you received extra is the unexplained credit. Section 68 is applicable because it's a credit to your bank account. They say, presume that you received in cash, in form of cash you received. Once you say that your section 68 is applicable, as per that, there's a new provisions on the special rates of taxation under 115 BBE. Under section 15 BBE will be special rate, that is 60 plus surcharge plus cess. Altogether is very high, heavy amount, and you are going to pay full amount as a tax liability to the department. Therefore, friends, as a consultant, you should be very careful at the time of drafting agreement. Please check the buyer and seller. What is the SR value on the date of transfer? And you should have that information. That is a minimum figure you have to mention the consideration. Otherwise, if you have mentioned some other figure, it is less than the stamp duty value, I think then you'll have a very big problem and you are going to pay huge tax to the government. That is in the hands of the seller. In the hands of the buyer, same officer will say, no, you have done some investment. It's called unexplained investment under section 69A. I will tax at a special rate. You have to pay on 20 lakhs at higher rate of tax. It means finally end up with the logically on 20 lakhs seller is pay what are the applicable tax under 115 PVE, and this buyer is to pay under 69A as unexplained investment. He is also going to pay same. Both together on 20 lakhs, 40 lakhs, and the tax liability is more or less equal to the 40 lakhs. Friend, this is the additional tax liability if you are not planned at the time of registration of a property. Therefore, I request all as you are consulted, you have to tell them that while when you're going for registration, please keep what is the basic SR rate. That rate is a minimum rate you have to mention in sale deed. Otherwise, you are going to have a problem later. This is what is very important. You have to keep it in mind when you are drafting any or you are assisting any planning or anything in the say at the time of forming the sale deed. Suppose under section 50C, it says very clearly you are disputed the stamp duty valuation. Suppose stamp duty valuation you are disputed and you are before the competent authority, for the this amount stated by the stamp duty is more, you are in the authorities specified in the government, state government authority. That case law says very clearly the income tax officer should refer these to valuation officer because the dispute of the stamp duty value, therefore you have to refer to the valuation officer. When you refer to the valuation of 55A of the Income Tax Act 1961, when they have to see independently the valuation officer has to value the property involved, you have to value that, and you forward the valuation to the assessing officer. At that time, the assessing officer has to see what is the value by the valuation officer, whether it is more than the stamp duty valuation, SDV, stamp duty valuation. If it is more than stamp duty valuation, then stamp duty valuation authority, then you have to take fair market value as consideration is stamp duty value of the authority. It means that it is more than the SDV, then you have to adopt the stamp SDV, stamp duty value of the stamp authority. That is the option. Next is if it is less than the sale consideration as per the sale deed, and of the stamp collection authority, then value assigned by the valuation. That is value what assigned by the valuation officer. That to be mentioned as the value for the purpose of this section 55 gives you very clear picture on this. Usually 50C, it says very clearly on the date of executing sale deed, you see what is the fair market value and what is the stamp duty value. Stamp duty value is more, then law presumes that 50C, that is the value to be considered for purpose of taxation in the hands of seller as a sale consideration, or in the hands of the buyer is investment, and that is to be decided. But we will have most transactions. You enter into an agreement, maybe after 3-4 years, after 3-4 years, you'll go for a sale deed. That time, what is the value you have to take it? On the agreement date value or the registration date? Because take for example, in 2015, I entered an agreement with one buyer and I paid substantial amount in check. That is very important. You should have paid substantial by way of check. Cash paid is not acceptable. You have to pay only by check. Substantial amount you have paid by that time of agreement to the seller, DDR use of letter media through a bank. Then that is what is the date? Substantial amount is paid. Then you can presume that the date of transfer of the property, and that date, what is the fair market value or a stamp duty value? That value to be considered for the purpose of this one. That is what very important. You have to keep it in mind. Setup of losses under the head capital gain. Friends, this is the capital gain is special chapter. Therefore, you have some special features in the setup of and carry forward of these losses. Therefore, I will take up this. First is inter-head adjustment. Within the heads of income, within the particular head, there is a very clear any loss from one source can be set up against the income from the other source of the same head. That is permissible even under the capital gain also. We have a loss in one particular long-term capital loss that can be adjusted against the long-term capital gain within the same head of income. Exception is long-term capital loss. This is very important. In all other section 70, it says any loss from one head can be from one source can be set up against the other source under the same head. It is permitted. But there is an exception in the capital gain chapter. This is a long-term capital loss can be set up only against long-term capital gain only. This is very important. You cannot set up against the interest source is not permissible. Loss should be set up against only if you have a gain. Otherwise, other source is not permitted. Inter-head, one head to other head, it means loss of one head of income can be set up against the income against the other head of income, but in the same previous year. But the exception is long-term capital loss can be set up only against long-term capital gain. I explained earlier. Short-term capital loss can be set up only against long-term capital gain or a short-term capital gain. Long-term capital gain or short-term. It means that here the very any loss from short-term capital loss, short-term capital aside, can be set up only against short-term capital gain or long-term capital gain. This is what you have to keep it in mind. Short-term, long-term, I explained only long-term capital loss can be set up against the long-term capital gain. Carry forward setup of losses. I know you can carry forward the losses, and this one under section 74 of the Income Tax Act. Short-term capital gain can be brought forward and set up against the short-term capital gain or long-term capital later within 8 years from the end of the year in which you have asked for cash. But for that, you have to file the return within the due date. That is what mandatory for filing of return of income. And section 74, that is a long-term capital gain can also be set off against the long-term capital loss, capital gain. Long-term capital loss will be long-term capital gain. That is also 8 years. For that also, you have to file the return under section 139, subclass 1. Friends, these are the exemption available to the assessees. What are the conditions they have to fulfill to claim the exemptions? Applicable to what type of assessee? What is the exemption? Friends, very important for all of us professionals is section 54. Section 54, I'll take first section 54. Section 54 says that any profit on sale of a property used for residence. It means any profit or on sale of a property used for residence. You are using the property for residence. You are selling this property. Then this is the coming under this definition. It is done by assessee, should be an individual or HF. The nature of it should be long-term capital gain. Capital loss will not, this short-term capital will not be considered, only long-term capital gain. For all the exemption, friends, kindly note. For all the exemption, kindly note that long-term capital gain only is entitled for claiming this exemption, not short-term capital is not permitted. Nature of asset is a long-term capital asset. Asset transfer is residential house, property being building, land there too. New asset purchased or constructed. One resident in India, one house property in India. You have to purchase within 1 year and construct or purchase within 1 year before or 2 years after the transfer. And construction is complete the construction within 3 years. That is very important. Capital gain tax applicable amount not utilized till filing of return. You can utilize, it is available for you to utilize up to the date of filing return. After that, you have to keep a specific backup. The amount of exemption available is if the capital gain amount is less than the amount invested, is less than the full amount is entitled. It means capital gain is having 100 lakh, but the amount invested in a new property is about 120 lakh. This full 100 lakhs is exempt from capital gain under 54. Where capital gain is more than the amount invested, the difference will be treated as a gain and is taxable to capital gain tax. And the transfer of a new asset, they're very clear. Within 3 years, if you transfer, that whatever the exemption claimed earlier will be taxed in the proper way. That's what the explanation. This is in respect of section 54. Similarly, 54B, this is transfer of an agricultural land. Transfer of an agricultural land, where it says used for the agricultural purpose and not to be charged to certain cases. When you invest or fulfill the conditions what I am going to discuss, then automatically you are entitled. Next year is, in this case, is applicable to individual or HF, and it is the nature of asset should be a long-term or short-term. This kindly note, this is the only section where short-term capital gain in the invested in agricultural land, you are entitled for deduction under this short-term or long-term. Asset transfer should be in agricultural land, held use for the individual or his parents for agriculture purpose during the 2 years before the transfer, and agricultural land in a rural area or urban area. This is a new asset created. Purchase within 2 years from the date of transfer, you have to purchase. Other sections, what is important is capital gain. If its amount invested is less, is more than the capital gain, then fully tax free. Or what you invested in this one, suppose capital gain and the amount invested is less than that, then the difference will be taxed in the hands of the seller as the capital gain. And also here is a new asset should not be transferred within 3 years. These are the conditions. Friends, for the exemption clause given under the any section which I want to discuss, another 2-3 things, we be very clear that to claim exemption, you have to fulfill the conditions specified under the particular section. And if you have fulfilled 100%, then only you are entitled. That is what is very important to take. Yes, you have to see that they are fulfill the conditions specified on this section 100%. The next section is 54D. This is a compulsory acquisition of a land or a building. Then this say any person, it is applicable to any person. Earlier, what I discussed is only for individual nature. Now this is any person in a partnership or company entitled. Nature of asset long-term capital gain. However, short-term capital in case of a depreciable building is permitted. Then compulsory acquisition of the land or building which was used by the SSC in the business of individual undertaking during the latest 2 years, prior to the date of transfer. This is very important. And the next is new land or building for the undertaking within 3 years from the date of transfer. We are not supposed to Transfer, if you transfer, that will be treated as a capital gain. Set off of that you have to file the return within 130 days, otherwise you have to keep the amount in the bank. This is what the thing. All other most probably all other provisions are similar way. Only thing is, next is 54 easy bonds. Friends, all of you know 54 easy bonds. Any person want to sold any property which is a long-term capital gain, it is a long-term capital gain, and you don't want to pay tax, then you can invest in these bonds. These are the notified bonds. If you invest in notified bond, then you are entitled for exemption. But this should be a land or building or both. This is for only land or building, not for any other thing. 54 EC. Next is when you invest this, you can maximum investment, it should be 50 lakhs, 50. 50 lakhs is the amount, not more than the financial year. Then now the amount, even subsequent year also you cannot invest. Maximum is 50 lakhs is the permittable for sale of a particular property, land and building. These are the property invested in NHA, Rural Electrification Corporation, Power Corporation of India, Indian Railway Finance Corporation. These are the notified security that is eligible client. If you invest 50 lakhs in this, you are entitled for deduction. You have to invest within 6 months from the date of transfer of the asset. You have to invest within 6 months from the, you have to buy the bonds from the notified asset. And if the capital gain or amount, if the capital gain is less than the amount invested, then full amount is exempted. And if the capital gain is less than the amount invested, then difference will be taxed as a capital gain in the hands of the seller. New asset should not be transferred within 5 years. That are the condition for claiming the exemption. Then is 54F. This is what majority we are going to deal with our associates. Mostly section 54 and 54F. Section 54 is very clear. When you sell the property, is used as a residence area. You sell the property, and if you buy another property, then you are entitled for the 54. But in the case of 54F, is not necessarily you are selling property is a immovable property. It can be given for shares also is entitled. You are in the case of investment in, and you have to use this amount for the investment in a residential. When you have to invest after the sale is over, you have to invest, or you have purchased already property, but you are selling subsequently. That's within the 1 year, it is within 1 year from the date of purchase, that also amount can be utilized. You have to fulfill the conditions specified under section 54. Yeah, these are one of the conditions is any sale of any long-term capital sale of a property, immovable property, or any shares is eligible under 54. Yeah, in case of 54 only long-term arising from a sale of a residential house is exempted. Here also this can be availed by individual or HF, and this should be a long-term capital gain. And any capital asset not being a residential house property, any transfer during this is a very interesting provision. It should be very clear. Section 54 gives some conditional attachment. It says that once you sell the property, maybe land or any other shares, you have sold the property, and you have to invest in this house for a living purpose. As you know that earlier only one house is permitted. Now in the last year they permitted 2 houses. 2 houses is permitted now. 2 residential houses is permitted. Suppose already I invested one property. I want to go for another property. Definitely you can go for this option. Sell the property, sell the immovable property, or sell the site or shares and invest in the new house. You are entitled. But in this case, they said that for other things you can invest in 2 houses. When you come to this, they say that you can invest in the second house, but when you invest, the capital gain arising from that sale of property should not exceed 2 crores. You can invest in another house is permitted, but the capital gain you want to claim exemption from the sale of that particular property, whether a site or a share, should not exceed 2 crores. The gain from that property should not be more than 2 crores. If it is less than 2 crores only, you are eligible and utilize that gain and buy another property. It is permissible for a second property. Under 54, no such condition. And 54F, there is a condition. 2 crores is the gain you can utilize for the purpose of this. Suppose you sold a property, your gain is some 2.5 crore, then it is this provision is not available to you. You have to pay tax. This is what 54 and 54 exemption given. After that 54G, when you are shifted the undertaking, a business undertaking, you shifted from the urban area to rural area. Urban area to is defined. What does it mean? Urban area and rural area. Take for example, earlier you have a factory in Visakhapatnam. It is urban area, but you want to shift to the rural area, which is outside the limits. Then you are entitled for exemption of whatever the investment you are doing in the whatever the sell and investing in that is eligible, subject to some conditions. Whether short term or long term, both are entitled in this case. Then you are entitled for what are the consideration received for shifting the undertaking, whatever you get, that you will be, when you invest there, you are entitled for 54G exemption. You are not asked to pay any capital gain tax on this transfer of an undertaking. Friends, I come to the now critical issues. So far, what I discussed with you, only the basics. You should know these are things before dealing with these issues under capital gain. Now, I'll request my friend Sandeep. He is going to discuss some of the issues connected to non-resident. After he's finishing that, I will take up the other issues. I'm having 53 issues. If it depends upon the time permit, I will tell the facts. I'll tell the decision. I have mentioned already decision here, our decision, and what is the final conclusion of that. This is what I want to take up all the issues so that you are well versed with the thing. Friends, I want to seek anybody is having any clarification on the so far I discussed around 53 slides so far. You have any point to make, or you want to add something to what I said, or you want to say something which is a special point or a new point which I have not mentioned in my presentation, you can raise. If you are not raising the raise, I'll hand over this thing to my friend Sandeep. He is my partner. He is going to take up the issues connected to non-resident taxation. If you have any issues, we'll discuss. Otherwise, I'll hand over the mic to my friend. Any issues are there in the chat? Any chat box?
Yes, sir. There is one question in the chat box.
What did it say, sir?
If the asset is purchased within 1 year, but after March of previous year and return is to be filed before July, generally, 1 year or 2 years will be applicable after due date, and consideration and profit is more than 50 lakhs. What is the duty of assessor to be done?
No, no. Sir, your question is, there are 2 sections covered in this. First is, what you want to say is, I sold the property. You have an option before you. There are 4 options to you as an associate. One is, first option is pay capital gain tax. What are applicable 20%? The one. Otherwise, you do a reinvestment in another house, whether I'm entitled for exemption under 54 or 54. Yeah. Or I am going on to this. I want to invest in a bonds, 54 EC bonds. That is another provision where 50 lakhs. Sir, in this case, what you ask question, you are elaborated in subsequently. It said that first year, take for example, 31st March 2021, very ideal. In the month of March 2021, you sold the property. Or you take January 2021, you have sold the property in January 2021. As per section 54 EC, within 6 months from the date of transfer, kindly note within 6 months from the date of transfer, you have to invest in a bond specified under section 54 EC. There is no question of 1 year before. 1 year before is a different. I will explain that later. First, bonds under section 54 EC is always within 6 months from the date of transfer. You have to invest in specified bonds. Now the question arises: I have done on 15 January 2016. I sold the property. 15 January 2021. I sold the property. I had to calculate from 15 January 2021 6 months, like a calculate 30 days. And find out 6 months when it is end. Before that, you have to invest and claim the exemption under 54C. I am very clear from the date of transfer, you have to calculate 6 months and invest before the 6 months. Within 6 months, you have to do it. This is in respect of 54EC. Some of the people are view and also some decision supporting me. They say that the month in which you have sold, ignore it. Subsequent month, you calculate 6 months. When it is passed, in the given example, January 2021, I sold it on 16th January. January ignore, February, March, April, May, June, July. Before 31st July, I have to invest in the 54 EC bonds to claim the deduction. This is the 1 hour. What I told 1 year is related to 54F deduction or 54. There is a very clear that it says that you have purchased the property, you already purchased the property, but you sold the property later. That gap between the sale and purchase is less than 1 month. Then whatever the sale capital gain arises from sale of the property, that capital gain can be set off against this investment and claim exemption as 54 or 54. Yep, that is what 1 year before. That is a condition for the 1 year before is only for 54 and 54F, not for 54 EC. This is what they. Shall I hand out mic to my friend?
Venkatesh sir, I have one question, sir.
Yes, sir.
The SSC has sold one property during the financial year 2021. That is
Okay.
last year.
Ah.
But he has kept that amount in the savings bank account to reinvest it in another house property. He is eligible.
Okay.
But before that, he expired.
Okay.
So what is the course of action by the legal hires? How we have to face this situation of reinvestment or paying taxes, or can we get out of this capital gains tax?
I understand, sir. But, sir, what are the legal obligation of the person who has sold the property continue to be in the hands of the successor? In this case, a family member, son or a daughter or a wife, they are the, what are the obligation which is the seller has to do it is no more. The successors, they have to do it and claim the exemption if they want. Otherwise, they have to pay tax if you are not invested in the specified securities. You are not invested or not invested in a property, then you are not. The next question is arises, sir, I sold the properties, Mr. X, he is no more. I have to invest is maybe Mrs. X.
Yes. Yes.
Then the department says, no. Mr. X is invested, you sold the property, invested by Mrs. X, therefore you are not entitled for exemption. You are not entitled for exemption 54 or 54. Yeah. But they're very clear, you invested in consideration in the new property. Some of the decisions are very clearly says that name is only a technical matter. It is the amount of what is the amount capital gain arises from sale of that property. You are invested in a new property, you are still entitled for that. And invested in the name in the name of wife for any reason, you are still entitled for it. But no legal heirs has taken a step to do anything. They are simply silent, and the time period of 2 years for purchase and 3 years for construction, and after you have to keep in a specified bank account before the due date for filing return of income. You have failed all this thing, technically it will be a problem, then you are not entitled for it. Therefore, legal heirs has to do what are the obligations of his father or his husband, and they have to fulfill. Then only they are entitled. If you are not fulfilled, then you are liable for tax. This is the what I direct answer, sir, without any thinking. But I am going to discuss some of the case paths of not this nature, something connected to this type. I will going to discuss. If anything is there, I will. Otherwise, I will request Sandeep.
Thank you, sir. Thank you. Members, any other queries? Or else we will continue the session with a partner of Dr. Venkatesh Garu for NRI capital gains taxation and other issues. Like.
Sir, another 2 hours is there, sir. You have to provide dinner to all your participants, to me also. 2 hours, still 2 hours is there. Now 6:10. Therefore, I want to elaborate discussion because I'm having a lot of issues. Depends on time, I'm going to take it. That's why I handed it over to Sandeep. He is going to finish the non-resident taxation. Any questions non-resident, you ask him, but he's going to present here. Then I'm going to discuss my issues. Any issues is there later also, we can discuss. Now I'll request Sandeep to start. Sir, I'll introduce Sandeep myself. Sandeep is a chartered accountant. He has done the articles in my office only. After completion of articles, he joined our office as an employee, looking after the litigation department, appeals. We have a separate wing for appeals. He was looking after under one of my senior partner, Ramasubramanian, under his guidance. Now he is expert in litigation. Any issue is there, only you want to litigate, you have to go to him. But anybody who want to solve the problem, they have to come to me. This is how we are bifurcating our assignment into two parts. With this background, I'll request Sandeep to present his paper or present his issues on the non-resident taxes. Sandeep, please.
Welcome, Sandeep Garu. So nice to see you through virtual.
Thank you, sir. Thank you so much.
Thank
This
you
is the
very
first
much for
time
your
where
time
I'm
and effort.
speaking with Visakhapatnam people. I'm glad, sir. I'm glad for this.
Thank you. Thank you.
Take your own time.
Okay, I'm sharing my screen where to discuss the issues. Yes. So basically, my senior has already explained the capital gains chapter with respect to residents. But what I want to make one thing clear is, with respect to section 45 to section 55A, 99% of the instances does not deal specifically with residents or non-residents. Everything is same with respect to residents or non-resident. They are completely same. Some portions of the provisions, they differ with respect to for non-residents. In case, for example, if it is a section 54 exemption, they don't differ for non-residents. Non-resident also is equally eligible for this kind of exemption, whatever they have provided in section 54, 54F, 54B, G, 54EC and all. Therefore, I am not going to deal with those things. Today, my flow of discussion will be very simple. Second proviso to section 48 of the Income Tax Act 1961 I'll be dealing, where this explains in case if there is a capital gains arising in foreign currency for a non-resident. So this is the basic one thing which has to be understood. When it comes to, there are other provisions also which deal with non-residents, something like rupee denominated bonds, Indian rupee denominated bonds, other gold depository bonds. I'm not going to deal with those things in this session because a lot of chartered accountants are not dealing with that. So it is not better if they have any specific query, they can mail it to me. I can deal with that without any cost also. I have no issues. But with respect to other things, I will be dealing with. Second is double taxation avoidance agreements. These are very, very important because when a non-resident is involved in this kind of taxation, where Income Tax Act is applicable, it is better to deal with the DTA because there are a lot of benefits provided under DTA and it is directly applicable. In the provisions of Income Tax Act itself, it says that you refer to DTA and Income Tax Act, whichever is more beneficial to the assessee, let them take that. So it is better to refer DTA and section 195 of the Income Tax Act. Usually it is called half charging, half enabling provision. As everyone knows, there are two provisions in the Act, two kinds of provisions. One is charging section for every charge. Second is enabling provision, the way of charging. Therefore, the section 194 is called as half charging and half enabling provision. When it comes to other thing is form 15CA and 15CB. How to tackle this kind of capital gains taxation in form 15CA and 15CB. I will show in case if it is taxable and if it is not taxable, how to report in form 15CA, 15CB. Starting from section 48 of the Income Tax Act, as I told you, second proviso to section 148. The key points of this computation of capital gains are like this. the assessee should be a non-resident. There should be a transfer of capital asset. There should be a transfer as defined under section 2, subclause 47. Third is a capital asset should be shares or debentures of Indian company. The proviso is very clear that it cannot be an equity share recognized in stock exchange. That is where you pay security transaction tax. For those things, this proviso is not applicable. Where I repeat, the capital asset should be shares or debentures of Indian company, but not a equity share which is listed in recognized stock exchange where security transactions tax are paid. So what is the step to compute the capital gains for non-residents in case of transfer of capital asset of an Indian company? That is, first is arrive at cost of acquisition, expenditure related to the transfer, and sale consideration in foreign currency itself. That is, in foreign currency itself. For example, I'm a US citizen or a non-resident of a resident of United States of America, USA. I will arrive at my sale consideration, expenditure related to my sale and cost of acquisition at the in foreign currency, that is US dollars itself. Then I'll arrive at the capital gains computation. How section 48 or 49 provides, we'll arrive at the capital gains. Then that capital gains will be converted to the foreign Indian currency. As an example, I'll give you. In case if the sale consideration is in Indian currency, but cost of acquisition is in foreign currency. First, we have to convert the sale consideration, which is in Indian currency, to US dollars, arrive at the capital gains, and then that capital gains has to be reconverted to Indian currency, and that capital gains will be liable for taxation. Provided if you are claiming any exemption, then you can take a benefit of the exemption, otherwise no. So this is the procedure to arrive at the capital gains. Next, with respect to DTAs, now I'll be dealing with some of the double taxation avoidance agreements entered into between India and other countries. Based on the usage of transactions, that is based on the countries with whom we have regular transactions, I have taken those countries. For example, South Africa, Australia, USA, UK, Saudi Arabia, UAE, United Arab Emirates, like this, Canada. I have not taken much of the countries like where Kazakhstan or Uzbekistan, those countries, because will not be dealing much with those kind of countries. But whatever I have seen with about 60 to 70 countries there are only 3 to 4 varieties of or kinds of taxation, which I'm going to deal with, where all with those 3 or 4 kinds of nature of transactions. So what is actually a double taxation avoidance agreement is, in brief, to avoid, the name of the agreement itself suggests that to avoid double taxation. In case if the residential status of a person, of an individual or of a person belongs to one country, and if the transaction is undergone or the property situated is in another country, how this taxation will arise? Sometimes both the countries, based on their domestic laws, may tax the amounts, transactions. Therefore, what has to be done is, then we have to refer to the double taxation avoidance agreement, and we have to see in which country the assessee has to pay the taxes, whether he has to pay in the country in which he is resident or the country in which he has done the transaction. So based on this one, to avoid this double taxation avoidance, the India and other countries have entered into this agreement. So I'll start with South Africa, which is very, very easy to understand. So Article 13 deals with capital gains. The entire section I have demonstrated in one table for easy understanding. And I am dealing with only articles which are very, very familiar and which are continuously the transactions being entered. For example, if it is something, a very, very peculiar transaction, I'm not dealing with those things. I'm dealing only with the provisions where regular transactions will happen. For example, when it comes to Article 13.1, that is paragraph 1 of Article 13, usually we'll refer as Article 13. And next, the sub-article, we will not call it a sub-article, we'll call it as paragraphs. So paragraph 1 of Article 13 starts with like this. If he's a resident of India, for example, I am Sandeep, I am resident of India. I am dealing with immobile property situated in South Africa. In South Africa, Johannesburg or Cape Town, I have a property, immobile property, assuming residential house. If I have to sell that one, that is taxable in South Africa as per the domestic law of South Africa, even though I am resident of India. This is as per DTA. The first question will arise, sir, you are a resident of India, global tax is applicable, how it is possible? I have made it very clear that double taxation avoidance agreement benefits are provided in the Income Tax Act also. Section 90 specifically states that you refer Income Tax Act, you refer DTA, whichever is more beneficial, you can ascertain that. So therefore, based on that, this overriding clause of Income Tax Act, I am referring to this DTA where it says, if an Indian resident who owns a immobile property situated in South Africa sells that, he is liable only in South Africa as per its domestic law. In case domestic law says 10%, he is liable for 10% taxes. In case if it is exempted, it is exempted. So it is as per the domestic law. What happens if he is a resident of South Africa? If in case in the same example, I am a resident of South Africa, then my property is situated in Visakhapatnam. How it has to be dealt? When I am selling the property, it is liable in India. So basically, what they are trying to say is, wherever the immobile property is situated in that country, taxability arises. So in case if the property is situated in South Africa, the capital gains is liable for taxation in South Africa. And if the immobile property is situated in India, then the taxation will arise in India as of provisions of section 111A for short-term capital gain or 112 for long-term capital gains. When it comes to section 13.4 and 13.5, here this deals with shares or similar nature. For example, even debentures also. So if is a resident, Sandeep, again in my example, Sandeep, resident of India, dealing with shares or similar nature in a company situated in South Africa. There is a South African company where they had issued shares, I had purchased it, and now I am selling. Where it is taxable? It is taxable in South Africa. So at what rate of taxes? It is as per the domestic law of South Africa. Here also, if you observe, it depends upon the company situated in South Africa. The shares of what you have purchased, to which of the company, to which country it belongs. It is South Africa. In case, when it comes to a resident of South Africa, when he deals with Infosys shares, then he has to, it is liable for taxation in India because the company Infosys is situated in India. When it comes to section 13.6, sorry, article 13.6, other assets other than above. For example, other than immobile property or shares, assuming there is some right to acquire some property, it's a capital asset as per definition of section 240. How it is taxable? This depends upon residential status. In case if the assessee is a resident of India, then any assets, let it be situated in South Africa or India, but that should not be an immobile property or shares of similar nature. It is taxable in India because he is an Indian resident. He can claim taxes. He can pay the taxes under section 111A or 112. If he is a resident of South Africa, And if he's dealing with the capital assets other than above assets, that is immobile property or shares, then he is liable for taxation in South Africa because he is a resident of South Africa. And the tax rates are applicable as per the domestic law of South Africa. This is one way of looking at it. This is one type of taxation which is in South African DTA. When it comes to, I'll deal with Mauritius. There is one interesting feature here which everyone has to understand. Here, if it is a same 13.1 deals with immobile property, as I explained to you, this is similarly applicable, similarly to South Africa. If it is a immobile property situated in Mauritius, then the taxability arises in Mauritius. If it is a immobile property situated in India, then taxability arises in India. Next, with respect to shares, there is one, I have given one remarks column in this, if in the presentation, where it says, if the shares are acquired on or after 1/4/2017, that is, shares acquired on or after 1/4/2013, that is 1st April 2017, then it is liable for taxation in Mauritius. A company situated in Mauritius. I am Sandeep, Indian resident, dealing with shares of a Mauritius company, but I purchased on 5th April 2017. In case if I am selling it, then I have to pay taxes in Mauritius. Luckily, in Mauritius, there is no tax for capital gains. So I repeat, if I'm an Indian resident, then I'm dealing with the shares of a company in Mauritius. I'm liable for taxes in Mauritius, provided I have purchased the shares on or after 1/4/2017. Likewise, resident of Mauritius, if he is dealing with any shares of a company situated in India, example Infosys, then he is liable for capital gains taxes in India as per section 111A or 112. And the subject condition is the shares should have been acquired on or after 1/4/2017. Yes, next. Similarly, where the shares which are purchased after on or after 1/4/2017, but sold on or before 31st March 2019, that is the period of holding is maximum is 2 years. In that case, if it is liable for taxation in Mauritius, then you have to pay 50% of the tax as per the domestic law. In case if it is liable in India for taxation, then 50% of the TDS as per section 111A or 112. This is very, very important. That is, assuming I have purchased, I am an Indian, okay, I am a Mauritius resident. I have purchased Infosys shares on 5th April 2017 and I have sold before 31st March 2019. Since I am dealing with Indian company shares, I am liable for taxation in India and I have to pay only 50% of the tax. For example, if I am liable for assuming 10% as per long-term capital gains, whatever it is, I have to pay only 55%. That is a tax liability on. Next, similar to the Mauritius, South African, this one, when a resident of India deals with any assets other than above, he is liable for taxation in India because his residential status is India. Here, example for assets other than above is shares acquired before 31st March 2017 of a company in Mauritius. Then he is liable for taxation in India. Just because if he has purchased the shares on or after 1st April 2017, then he is liable for taxation in Mauritius. But in case if he has purchased shares before 31st March 2017, then he is liable for taxation in India because he is an Indian resident. Likewise, resident of Mauritius dealing with shares of an Indian company before 31st March 2017, which he has acquired, then he is liable for taxation in Mauritius as per domestic law of Mauritius because he has not purchased the shares on or after 1st April 2017. So this is with respect to Mauritius. When it comes to United Arab Emirates, this is very similar to South Africa. Why I'm taking about, even though it is very, very identical to South Africa, why I'm taking this, I just want to deal with the major countries where we are dealing with our clients, or our whatever, who are the clients we are handling, they are dealing with these kind of countries majorly. That is the reason I want to cover all these countries, even though I can cover only 4 or 5 types. UAEs will be similar. Canada is completely different. This is the second type or third type of third nature of transaction. Here, they don't deal with respect to immobile property, shares or securities, or any other asset. They deal with very, very simple thing. Any capital asset situated in India, if is a resident of India, it is liable for taxation in India and Canada. That's what they are saying. As we have said, this double taxation avoidance agreement is for avoiding the taxation, avoiding double taxation. But the DTA itself says that you are liable for taxation in India and Canada, both. Assuming I have some immobile property in Canada, I'm an Indian resident, I am selling that Canada immobile property. I am liable in India and Canada, both. How this taxes will be paid in both the countries and how the relief will be claimed. This is the moot point here. In Canada, whatever the taxes has to be paid, I'll pay it as per the domestic law. And when it comes to India, I'll compute the capital gains as per section 111A or 112 as the case may be. That is short-term capital gains tax or long-term capital gains tax. But when I'm arriving at the final, at the end, that is the balance tax payable, I will go to section 90 subsection 2, where it says, where it provides relief. Relief will be provided if I am liable for taxation in both the countries. I'll just give an example of this. As I told you, I am liable for taxes in both the countries. So I'll be paying taxes in Canada. For example, for an 100 rupees of capital gain, I'll pay taxation of 10 rupees or 10 rupees. Then when it comes to India, as per my section 111 or 112 as the case may be, I'm liable for 25 rupees of capital gains tax. So what I will do is 25 rupees minus 10 rupees what I have paid in Canada. This is the relief what I'm claiming as per section 90 subsection 2. So the final end will be, the final taxes payable will be 15 rupees. So what I'm trying to say from this Canada agreement is very simple. Here also you are liable for taxation in only one country. But it depends upon the country in which you are filing the return of income. For example, as I told you, in Indian resident, he is having a property situated in Canada, he'll pay the taxes and he'll get away with it. He is not required to file the return of income in Canada. What he has to do is, he will file the return of income in India, he'll calculate the taxes and he'll reduce the taxes paid in Canada, and the balance taxes will be paid. Likewise, for a resident of Canada, he has to see any capital asset.
Okay.
Someone is unmute, sir. Can you mute yourself?
Yeah, I'm just doing.
Okay, I feel I'm audible. Yeah. So when it comes to a resident of Canada, if his capital asset in India, then he is liable to pay taxes in India and Canada, both. In India and Canada, both. So he will file the return of income only in Canada. He will not file any return of income in India, assume. Then whatever taxes he has been paid in India, he can take as credit in his return of income paid in Canada. It can happen both the ways. An Indian resident can file the return of income Canada if that country allows, and he can take any exemption what he has provided. But the thing is, In case if he is filing a return of income in Canada for this transaction, then we have to see what kind of exemption is provided. But I'll give an example for a resident of Indian and Indian resident and Canada resident. An Indian resident selling a capital asset situated in Canada, he pays the tax applicable in Canada, and he files a return of income there. Provided Canada domestic law gives exemption or some kind of relief as provided in under section 92, he can claim the exemption there also. But on a practical thing, I'm giving an example. An Indian resident selling capital assets situated in Canada, in India, he will file the return of income. Whatever the taxes he has paid in Canada, let him take the credit. This is allowed as per section 92. It is also allowed as per article 23, paragraph 1, where they can take the credit. I'll give one example. Next example is my taxable, as I told you in the last example, 25 rupees is in India, 10 rupees is in Canada, tax liability. But here we'll reverse the situation where 10 rupees is my tax, that is in India, 25 rupees is in Canada. So what I can do is I cannot take the credit to the extent of 25 rupees also. I can take credit only to the extent of whatever I am liable in India, that is 10 rupees. Remaining 15 rupees, I can claim as an expenditure. I can claim as expenditure. I'm very clear when I'm saying that 15 rupees, we can claim it as an expenditure. It is an allowable deduction. But for this, some 3-4 conditions have to be satisfied. What is that? Is tax residency certificate should be available. In case if he's a Canada resident, if he wants to claim any relief for the taxes paid in India, he has to have his TRC in his country. Next, taxes paid outside India has to be claimed as relief under section 92. This one I've already explained. If taxes paid more than what is liable in India, then the same can be claimed as expenditure. This also I have explained. I'll repeat once again. If in India, an Indian resident is liable for taxation, then his tax liability is 10 rupees, but he has paid 25 rupees of tax in Canada. Then what he has to do is 10 rupees minus 10 rupees, only he'll get the relief. That means we are not liable to pay any taxes in India. The 25 rupees, whatever we are paid. But in addition, that 15 rupees, whatever the excess paid in Canada, you can take as expenditure. You can claim it as an expenditure. When it comes to Australia, this is similar to South Africa and Mauritius. When it comes to China, yes, China is also similar. Cyprus is also very similar. France is also similar. Germany is also similar. Greece is very similar to Canada. That is, any capital asset situated in Greece. So it will have for taxation in Greece, and domestic law of Greece will be applicable. But we can claim relief under section 90 subsection 2. Hong Kong DTAA is also similar to South Africa. Ireland is also similar to South Africa. Italy is also similar to South Africa. Japan is also similar to South Africa. Malaysia, South Africa. Netherlands, there is one interesting issue is, if he is a resident of India, that is Indian resident, if he is dealing with the shares, in a company situated in Netherlands, then it is liable for taxation in Netherlands. Taxes as per the domestic law of Netherlands. But it should be other than shares quoted on approved stock exchange. It should be outside, it should not be a listed shares. This is the only condition where it is different from other countries here. But because if you see, in case if shares recognized in stock exchange, then article 13.5 is applicable. That is, a resident of India, assets other than above, he'll be liable for taxation in India. he'll be liable for taxation only in India, because if they are shares recognized in stock exchange, listed in stock exchange, therefore it will not fall under other capital assets wherever it is provided in 13.1 or 13.4. New Zealand is similar to South Africa. Russia is also similar. Saudi Arabia also similar. Singapore is similar to Mauritius. As I told you, the shares should be acquired on or before 1/4/2017 and sold before 31st March 2019. You will get two benefits. Switzerland is also similar to South Africa. United Kingdom and USA are similar. This is where it is similar to Canada. I repeat, there is only one paragraph in this one. A resident in India is selling any capital asset situated in UK, then he is liable for taxation in India and UK both, as per the domestic law. But they can claim relief under section 92. Even though if they want to file the return of income in UK, even though he is an Indian resident, if it is allowed in UK domestic law, then we have to say, then he has to see what all the benefits he'll get. But if he is filing in the Indian territory, that is in India, if he is filing the return of income, then he can claim relief under section 90 subsection 2. And in case if he has paid more taxes, whatever is liable in India, more than whatever is liable in India, then he can claim it as an expenditure. USA also is similar to UK and Canada. So with this one, I have finished the DTA, which are where 4 types. One is South Africa, which is very normal. Second is Mauritius with respect to shares which has been purchased on or after 1/4/2017 and sold before 31st March 2019. Third is with respect to only one clause where it is liable for both taxation in both the countries. So these are the 3 situations where I have covered. Yes, next is section 195. We have to keep in our mind this is very important section where none of section 194, 194A, 194C is applicable when if it is a paying any amount payable to non-resident. It is only section 195. Section 195 also creates the charge, but rates you have to refer 2 sections. One is 115A and Finance Act rates schedule. So when it comes to capital gains, irrespective of if it is taxable in India, chargeable to tax in India, then they have to pay taxes as per section 111E or 112 rates itself. For example, I'm just giving as an example. In case if it is royalty or fees for technical services, then they have to refer to section 115A, where the tax rates are shown as 10%. But if when it comes to capital gains, it is section 111A or 112. And any person responsible for paying to a non-resident, if a resident is paying any taxes to a non-resident or a foreign company, then he has to deduct tax at source. When it comes to, I want to repeat one more thing is, when it comes to a sale of immovable property capital gains, we will be following 194IA for residents, but this is for non-residents, section 195. 194IA is not applicable. And the nature of payment, let it be anything, but other than interest under section 194 LB, LC and LD and salaries. What is the time to deduct tax at sources? At the time of credit of such income to the account of payee, or at the time of payment, whichever is earlier. There is no threshold limit. Even if it is 1 rupee also, they are liable for taxes. Even if it is 1 rupee also, they are liable for taxes. Until unless and unlike like section 194C or 194J, where it gives a threshold limit of 30,000, 1,20,000 to 1 lakh rupees. Here, there is no threshold limit at all. Some of the salient features of this section and rules are: the non-resident can apply for lower deduction or nil deduction certificate with the assessing officer. In case if the assessing officer is satisfied with the condition satisfied with by the seller non-resident, then they will issue certificate of lower deduction or non-deduction. So as provided in section 197, the similar benefits are available for a non-resident also under section 195. The rules which have to be referred are rule 26, 28, 28AA and 28AB. I'm not dealing completely with the procedural wise. I'm dealing only with the principle wise. That is the reason I'm not given elaborate. Next is form 15CA and 15CB. Why I'm very much focusing on form 15CA and 15CB is for any foreign remittance, even sometimes it is a current account transactions, that is for personal purposes, you have to give a form 15CA and 15CB to your banker. Sometimes form 15CA and 15CB both has to be provided. That is the reason I am stressing on this form 15CA and 15CB, even though it is not completely a part of capital gains chapter. So basically there are two forms. One is form 15CA and form 15CB. Form 15CA arises in four parts: part A, B, C, D. Form 15CA is a self-certified or self-data provided by the assessee itself. What is that data is part A, B, C, D. When this thing will arises, when the remittance is less than 10 lakh rupees, whether it is taxable or not, you have to fill only part A of form 15CA. Assuming my amount transfer is 4 lakh rupees. 4 lakh rupees. Then the part A will be applicable, even though it is liable for tax or not. Part B will be applicable when there is a 194.2, 195.2 or 195.3 or 197 is applicable. That is nil rate or lower rate certificate, tax deduction certificate is involved. Part C will be applicable when there is a remittance is more than 5 lakh rupees. That is 10 lakh, 15 lakhs like this. Part D is applicable when the income is not chargeable to tax. Assuming I am making a donation to a country, to Saudi Arabia or some Afghanistan country or Israel country, which is not chargeable to tax in India. Therefore, I am filling up part D. Form 15CB will be along with form 15CA only if it is exceeding 5 lakh rupees. Only if it is exceeding 5 lakh rupees. Whether it is liable for tax or not. Whether it is liable for tax or not. If the amount is exceeding 5 lakh rupees, form 15CB has to be provided. I'm providing two form 15, I'm showing two form 15CBs as a format where one form 15CB shows capital gain taxation, another form 15CB shows non-taxation. This is a form 15CB where the taxability doesn't arise. If you see, we are giving the details of everything. That is, what is the Indian currency, what is the foreign currency, everything. And the main part is parts para 7, which is a purpose code as per the RBI. That is other capital payments not included elsewhere. When it comes to, as per section this one, taxation, it is section 112 of the Income Tax Act is applicable, and the amount of income chargeable to tax is this much. The tax liability and other provisions, other basis of determining taxable income and tax liability is also defined as section 112. When it comes to DTAA, we are seeing whether tax residency, if any relief is claimed under DTAA, nil. Tax residency certificate, whether it is available, yes. And at the end, we'll give it as here, purchase of equity shares. For that one, we are remitting the amount, and it is not taxable in India as per DTAA, and therefore, as per Article 13.4, I am claiming an exemption. Which one? The amount of TDS will be nil. Rate of TDS will be nil. Sir, from Raitu, sir. So when it comes to other one, yes, here it is taxable. So with respect to USA, what we have mentioned is here as per section 112 also it is liable for taxation. When it comes to as per DTA also, here it is taxable. In case of other remittances not covered by ABs, it is taxable. Purchase of equity shares and the rate of taxes 21.22% as per the Income Tax Act. So we are giving the amount of TDS Indian rupees, in foreign currency also, and in Indian currency also, what is the remittance after TDS. So this is form 15CA, 15CB. What I will do is I'll share my presentation, form 15CA and 15CB, all three put together to the branch so that they can circulate and you can use this one in a similar circumstance. With this one, my presentation ends. If anyone wants to ask any questions, I'm ready to answer. I'll see in chat box anything is there or not.
Sir, one question, sir.
Yes, sir, sure.
See, suppose NRI is there.
Yes.
He sent money to his father. Because it is in Indian rupees only in his savings account. Then he has invested in capital asset here. He has purchased a flat. So after 3 years, suppose if he sells the property, is he liable for capital gains?
No, he is not liable for capital gains. He is liable for capital gains, normal taxation. If he is investing in some other thing, he can take the exemption.
Though he is a non-resident.
Yes, though he is a non-resident, he can claim the exemption, provided your section 54F is this one allowed, because no section in 54F will restrict the exemption to non-resident. Non-resident also can claim exemption.
Thank you.
And some question has been asked as, can buyer, a resident of property, apply for lower deduction? Any such facility? Yes, sir. They can claim, because section 197, even though they deal with under chapter 17B for the purpose of capital gains, if they are saying that they are not liable for much of taxes, they can apply for lower deduction. The law agrees for that, provides for that.
Members, any more queries? You can unmute yourself and you can ask the speaker. So thank you very much, Sandeep Garu, for
sir.
your elaborate presentation on NRI capital gains taxation.
Thank you, sir. And now Venkatesh sir will resume in next in 1 minute.
Issues. Yeah. Okay.
Yes, sir.
Members, now the speaker, Dr. D.R. Venkatesh, will deal with the critical issues in capital gains. just in a minute or so.
Sir, in the meantime, we can request all the participants to join for tomorrow's function, sir.
Yes,
Tomorrow's
yes,
August
yeah.
15th function.
Members, we have a flag hoisting on the occasion of 75th Independence Day at our branch premises. Flag hoisting will be at 9 o'clock in the morning, followed by breakfast. And by 11:30, we have one CSR activity we are undertaking, distribution of food and masks and sanitizers to the inmates of St. Joseph's Old Age Home. I request all the members to join for the flag hoisting and other CSR activities of tomorrow.
Yes, sir. Start.
Yes, sir. Yeah, yeah.
Yes,
Please,
sir.
please. Okay.
Sir, now we are coming to the critical issues on the general provisions of the capital gains. Now you are familiar with the non-resident taxation. Our Sandeep. Actually, I want to tell something about Sandeep. Sir, Sandeep is recently married. Actually, every Saturday our office is holiday. But today I forced him to stay here and join me and assist me in this presentation. Therefore, his wife will definitely have some classes later. With him, I'll wish Sandeep will have a nice time later. Okay.
Okay.
Sir, now I have taken his issues. I have given a few facts on that issues, and I want to discuss. I want all of you to, all the participants to participate and give your views or you ask clarification or you want. First question, there are 53 clarifications, 54 issues, 53 issues I am going to discuss. First issue is where assessee has purchased an agriculture land. This is a very big problem, that agriculture land. I think in Visakhapatnam also all friends you are facing that. And immediately thereafter converted it, said land into non-agriculture for commercial use. It will be regarded as a capital gain or a business. This is a question mark. See, here is assessee purchase agriculture land. After some time, he is converted into, say, assessee himself has converted into non-agriculture purpose as a commercial use, and he is sold. Whether treated as an agriculture land or is a business income. This is the question. Sir, here is the question is, because the assessee is purchased and sold, is a nature of trade he has done. As per the decision quoted here, Harish Kumar, very clearly this says he should treat as a business. Is not a capital gain. Is not treated as capital. This is a one. Countering this, suppose I told the owner of an agriculture land, I'll say that I'm buying an agriculture land, enter into an agreement. I'll say, please convert it into commercial, convert it into a non-agriculture and hand over to me. That is it. That is, it will be treated as agriculture is converting into this. Then it is a commercial. But agriculture sells a land to somebody. He has not done conversion, other things. He has sold the land as it is. Agriculture land as per revenue records. In agriculture, he sells the property to other, but it continues to be an agriculture land. Then the agriculture land is not a capital asset for purpose of taxation under capital gain, no capital gain tax. Therefore, you should know the facts. And simply because agriculture land, it is exempted, you should not. Usually, all the chartered accountants or consultants are very forced or very fast in giving the reply. Don't give, please collect the full facts. Whether agriculture land, yes. Today, what is in agriculture land, when is date of sale, whether it's in agriculture land, who sold the land, whether he has done any conversion. If he has done conversion and sold subsequently, it amounts to a commercial activity, is liable for business income. In this case, next example, a share broker, his duty is to coordinate for buying and selling of shares to the others. But incidentally, what he has done is having some shares. He purchased some shares of good companies and is holding as a is personal investment in his balance sheet, and he subsequently sells it, whether it's a capital gain or is a business income. This case law is very clear. Ketan Kumar Yesha, this is the decision. I given all the citation. In that very clearly says that when you a share broker, even though his duty is to buying and selling of shares for others, but he has purchased shares for his personal and shown as investment, subsequently sell after the specified period, it will be treated as a capital gain and is liable for capital gain tax. That is the next. In this case, assessee sold an agricultural land, he is an agriculturist, he sold the agricultural land and claimed the exemption, it is not liable for tax. Fine. Ever rejected the claim of the assessee, saying that you have not used this land for agriculture purpose. What is the reason? Is an agricultural land. From last 5-6 years, I have not done any agriculture activity. It is a continuous to be an agricultural land as per the road record. But I have not done any agriculture activity. But it is an agricultural land as per the revenue records. Then the assessee claimed is exemption because an agricultural land is outside the definition of capital asset, therefore is not liable for tax. But income tax officer say, no, you are not done in agriculture. They say that you want to fulfill the condition of agricultural land, you should carry on agriculture activity every year. Every year you have to carry on the agriculture activity, but you are not carried on. There will be a business and you are liable for tax. You are liable for tax. But tribunal held records are showing the land or agricultural land classified as a dry land as per the revenue authorities record. Tribunal also held that merely because adjacent land was divided into plots. What happened in this case? This land, adjacent lands are converted into plots. Therefore, they say this is a commercial thing, you have to pay capital. They don't know what he has done, the adjacent owner has done, it is no relevance to me. You is an agricultural land. You are not carrying agriculture duty for any temporary reason, any reasons. You are not to be treated as a non-agricultural land and you are not liable for. It is still you are entitled for exemption specified under the section. It is an agricultural land exempt from capital gain tax. This is what the CIT versus Venkatesh Hospital. This is the decision I quoted here. Another land is an agricultural land in the revenue records, but other circumstances are comparable to price fetched by the other building sites and price which was no benefit agriculturist would purchase same for a genuine agriculture operation and no evidence of agriculture operations carried out and had been placed on the record. Land could have not be held as a. What happened in this case? The land purchased by them is an agricultural land, but the land is in small portion. It cannot carry an agriculture activity. By any person who buys, he cannot carry an. Therefore, subsequently sold. You cannot treat as an agricultural land because you cannot carry on any agriculture activity in this land. Therefore, it is not an agricultural land. You have to carry, it is liable for tax. Friends, you see, each fact is a different, each depends upon the fact. Your treatment in the taxation also changes. Therefore, friends, you have any questions on this agricultural land? I have so many examples. I've taken 6 or 7 examples to say agricultural land per se is not liable for capital tax. At the same time, is not exempt from the capital gain tax. Therefore, you have to see the facts and circumstances of each case. Based on the issues, please decide the taxability of the agriculture, sale of agriculture land. Here is a case where agricultural land was approved to be converted into land for a non-agricultural purpose before sale of such land to be treated as an agriculture. You see here is. In this case, the agricultural land approved and to be converted into land for a non-agriculture purpose before sale of such land, but the tribunal decision said that even it will be treated as an agricultural land, even though you are converted. But this decision will not agree because if you are converted before sale, it should be a non-agricultural land, is liable for capital gain tax or whatever the business property. But this is a decision is there just for your information. I have mentioned here. Mere classification of land in a revenue records as agricultural land will not conclusively prove that the nature land was an agricultural land. You see here. Here is this decision says that mere classification of in the revenue records of the department, state government, as agricultural land is not a conclusive proof. It means that you want to prove there is an agricultural land, you should carry an agricultural activity, and at the time of sale, you should have that status of the agricultural land is continuing, and you have proved that you have done an agricultural activity. Then only it's treated as an agricultural land. Keeping agricultural land as per records, but you have not done any agricultural activity, then you are not entitled for the exemption. This is a contradiction to earlier decision what I said. Sir, whether a question of whether a capital asset is a short term or long term has to be determined according to the law as on the date of transfer and not as on 1st April of the relevant assessment. This is very important. Sir, this asset is a short term or long term. You decide on the date of transfer of a property, not on the beginning of the year. Because usually they think what last year we have purchased, this year selling is less than 12, but no. You have to calculate at the date of transfer how many months I am holding this one. I am holding more than 24 months, then is a long term in case of a immovable property. If less than 24 months, then is a short term. You have to decide on the date of transfer, not in the beginning of the year. That's what is this decision. Suppose you enter into an agreement that you have to perform some contract in related to the sale of immovable property, and if you are not performed that particular agreed terms, then you have to pay some compensation. And in this case, something is paid for giving up the specific performance of the amount of relation to a capital asset will be treated as a capital asset and is liable for capital. Whatever you get a compensation because of the giving up the enrichment of the capital right in the capital asset will be treated as a capital asset and is liable for capital. This is very interesting. In this case, where assessee has to clear some of the liability related to the encumbrance. This decision says that whatever the amount you have paid for to remove the encumbrances of this property will be treated as a cost of acquisition. You are entitled for the deduction from the sale value. This is very interesting. One more decision is which I am going to discuss, where they said that it is not. I think the next decision is that only. But in this decision, very strange decision, it says Rangarajan. This is the Chennai decision, Madras High Court, where they held that any amount you have paid to terminate the encumbrances or to get a good title, that will be a cost of improvement. You are entitled for deduction. But the next case, amount paid by us in discharge of mortgage created. Mortgage, the encumbrance is a mortgage. After acquiring property, would not be deductible expenses while computing capital gain. In this next example, it says any amount you are paid to discharge the mortgage of the property, what is that? This one? That is not a cost of this one, but today says it is a cost. There is a for encumbrance. To remove the encumbrance, you pay the amount and that can be considered as a cost of that capital asset and you claim the deduction. It is permissible. But if you have a mortgage property, you want to discharge the mortgage by paying the amount and subsequently you want to acquire the property. The seller, what he paid for the discharging the mortgage deed is not at all deductible expenditure as per this decision. Sir, very interesting. Where assessee is a partnership firm of a chartered accountants, transferred his client's relationship and goodwill pertain to its business of internal. We have a big office. We have an internal wing, statutory wing, income tax wing, GST wing, litigation wing. Like that, we have a various wing. But they decided to sell this. Internal is not that much fetching, and the risk consultancy group. All these clients who are in this internal wing, they want to transfer to some company, other entity, or the international firm they want to buy. They paid some certain consideration for transfer of this internal wing of particular chart accountant. and they received some consideration. They wanted to invest in a 54 EC bonds. The chart accountant want to utilize 54 EC, invest 50 lakhs. Finally, court held that yes, this is an asset. Giving a right in the internet wing of a chart accountant is a capital asset, is a right. He is entitled for investment in exemption under 54 EC. This is very interesting. Suppose you want to dispose of, you claim exemption under 54 EC, 50 lakhs will be exempted up to that. That is the one of the. This means giving up my right in a particular division of my audit firm is a capital asset. Therefore, what consideration will receive from the buyer is the consideration chargeable to tax under capital gain. Once is chargeable under capital gain, then you can invest under 54 EC. You're entitled. This is the decision which is in our favor. You can utilize that. Sir, here is a case this is frequently we face in our practice. To claim 54 exemption, as you know, the exemption under 54F for the sale of any property other than the residential. If you sell the property, if you sell the property 54, you use the section 54. Sale of any residential is buying another. Section 54 you use, but 54F is for sale of other than residential, any other vacant site or a shares. Then if you invest in another house, you are entitled for exemption. But in section 54, they said very clearly you can invest in one more house from 2017. The two houses are permitted. But in 54F, there is a condition that after the time of sale of this consideration, this asset should not own more than one house. It means in this condition, 54F, suppose I already having one house, I want to buy another house. It is under 54 is exempted. Under 54F is not possible. This is what the distinction between 54 and 54F. Therefore, friends, under 54F, you should, when you are selling the property, you should not own more than one house. You should, only one house is permitted. Second house is not permitted. Under 54, two properties are permitted. And the 54, there is one more condition attached in 54 is capital gain arising from the sale of a new the sale of property should not exceed 2 crores. Capital gain should not exceed 2 crores. That is all the condition attached. If your capital gain arises is less than 2 crores, then we can invest in another house and claim the exemption under 54. That is permissible. But 54F, you should not own more than one house. Even though 54 permits you to buy two houses, 54F is permits only one house. Therefore, you have a contrary this one. And in this case, suppose you sold the property, you sell the property today, and invest in another house is permitted because this is the in account to section 54. But I purchase the property already, but I am not selling this. My shares are vacant site now because the price is not good. I'll wait, and 6 months after that, I want to sell this property. And capital gain, whatever others I want to utilize against this property purchased and claim the exemption under 54F. It is permissible provided you should not own two houses on the date of the sale of the shares or a vacant site. You should not own more than two houses. But what you purchase new also is a house. Earlier you have purchased one house, you have purchased one more house, then you are not entitled for 54 exemption. This is what you have to keep it in mind while advising your client. All the case laws I mentioned here, you can take the case laws and read if you want further any clarification. In this case, where assessor is sold the residential house and invest the sale consideration in the plot for the purpose of construction of a residential house, merely because assessor could not obtain the cession of the plot within the 3 years due to developer failure to offer the possession to the assessor claim for the exemption of 54 could not be denied. This is very interesting. Here is what we'll do. Usually we invest property in developer. We tell the developer saying that please construct the property before 2 years in case of purchase, 3 years in case of construction. We say this is what we have. He says yes, everything you invest and claim exemption 54. But developer has not completed the project within 3 years. He is delayed for some reason or what are some statutory problems. Then if he has not completed, still you are entitled for deduction. This is a very interesting decision, but this can be used only when exceptional cases. You have advised the associate to complete the house within 3 years or 2 years, you have to complete. But due to some reasons, then you can utilize. Is a fault already committed, then you can use this case law and claim the deduction. Here is a question where long-term capital gain arises from property, whether you are entitled for 54F deduction. Suppose if you are not utilize that amount within the due date prescribed under section 139 for filing return, you have to keep it in a separate bank account. That is one of the requirement under the 54 or 54F. Permit 54G, 50, all these sections very clearly says that before the due date you have to deposit. The due date is mentioned is 139. They are not said 139.1. They say 139. Therefore, this case law says that no. If it is a 139 means it was 139.1 or 139.4. Therefore, if you deposit the amount within the time allowed under 139.4, still you are entitled for deduction. I am giving the decision. Friends, you have faced any problem, please use this decision and quote before the authority saying that this is the decision, it is in my favor, please allow it. This is a Delhi Tribunal decision, kindly quote. My friend was explaining, Sandeep, property when we want to claim section 54F, whether it invests a property in India or property anywhere in the world. In this decision, friends, here is Venkat Dilip Kumar. This is a decision of Madras High Court. They said that sell the property in India, invest anywhere in the world, you are entitled for deduction. Section 54, no restriction that you have to invest in only in India. Under the Income Tax Act, Indian Income Tax Act says that you sell the property and invest in anywhere in the world, you are entitled for deduction under 54F, 54.1. That is a decision of Chennai Tribunal. It is Chennai High Court. It is in the favor of the associate. The next decision, I'll going to give the decision where they said that you have to invest only in the India. There is one more decision is there which I am going to discuss later. Then you have to invest only in India. One decision in favor of the associate, invest anywhere in the world. Another decision, you have to invest in only in India. Take the decision which is beneficial to you and advise your associates accordingly. Sir, period of 6 months mentioned in 54 EC to be considered 6 calendar months and not 180 days. I have discussed earlier, I was telling in the beginning of my presentation, I was telling 6 months means calculate 180 days from the date of transfer. That is the correct calculation. Suppose you sold the property on 15 January 2021. As per decision he says January you have to ignore. February, March, April, all the 6 months you calculate. Then if you invest within that, then the 54 EC is available. But one more interpretation is 180 days from date of transfer. That is a strict interpretation. But this tribunal said that no, ignore the month in which he has sold. Take the subsequent 6 months. Within 6 calendar months, if he invests in 54 EC, is entitled for. That may fall within the previous year, it may fall in the subsequent year. There is a different thing, but 50 lakhs is met. Somebody asked 50 lakhs, whether I can invest 50 lakhs in the current year. Suppose sold the property in the month of January, I am having 6 months to invest. Before 30th, 31st March, I invest 50 lakhs. Another 50 lakhs within 6 months, by June, another 50 lakhs. Friends, the law is amended now very clearly. 50 lakhs, including the year of sale, plus including the subsequent year, you can maximum invest it only 50 lakhs. First, in the beginning of the section, when introduced, 6 months was the period. Now they added in the year of sale plus in the subsequent period together is 50 lakhs. It can have to be 50 plus 50 is not possible. In case of a joint development agreement, friends, you know joint development agreement where the developer agreed with the owner to construct a joint development apartment or a layout, and he'll take the possession of the land and start getting license, all the things he's going to do, and make the apart to construct, and subsequently hand over to the owner, whatever is share, you give it. Take for example, the 1 acre of land is given by the owner, and he is entitled for 50% of the constructed area. After the construction is completed, now the question is, as far as the owner of the land is concerned, he is handing over the possession of the land to developer in the year number 1. He start developing the property. Maybe after 5 years or after 3 years, building is ready, apartments are ready. In the 4th year, he is handing over the apartments to the owner, whatever is agreed. Now the question for the income tax is, in case of a JD agreement, when the transfer takes place, sir, if you examine all the issues, all the classes of JD agreement, any standard agreement, I am handing over the possession to the owner. Possession to the developer. The owner of a land handing over the possession to the developer in the year number 1. Then the land is transferred during that period. How much land I transferred? A land transferred to the extent of land on which he is constructing his apartment, his share of apartment. Whatever my apartment, which is I am not transferring because it is my property, I am not transferring. Is an example is 50% is the sharing arrangement. 50% of the land I transfer to the developer in the year number 1. Therefore, the owner has to pay capital gain tax in the first year on 50% of the fair market value of the land, strictly speaking. That is number 1. Number 2, after the construction is over, the owner will get the constructed area. What is the fair market value of the constructed area? On that, what he gets the fair market value, on that he has to pay again. Business property we sells immediately or sells after 24 months is a capital gain. This is what. Now, we are thanks to the present government, they said that no. Now, this JD agreement, which is a specified agreement under 45 sub class 4, they said this all capital gain tax, all this you have to pay in the year in which you got the possession certificate from a competent authority. You have started constructing, but you have to get a permission from the competent authority to possession certificate to hand over the property to the owner or a prospective buyers. That is the year in which you have to pay capital tax. This is what, otherwise you have a lot of controversies. These are controversies before this amendment. Now any section is very clear now. If it is only when a year of occupancy you receive under 45 thing, then you have to pay tax. This is a new section introduced. This is very interesting. I explained to you section 50C. It says 50C says that stamp duty value for the purpose of stamp duty collection, suppose if it's 10 lakhs, but consideration mentioned in the sale is only, take for example, is 8 lakhs. Law says that then for the purpose of taxation under capital gain, section 50C, it says stamp duty value should be considered as the consideration received for the purpose of this 50C. That is only limited purpose, that is it. Now this case law says that the purpose of 50C, suppose you take stamp duty value, that is the consideration. For the purpose of 54F, because you receive only actual consideration, only actual consideration received should be considered for 54F, not the deemed consideration mentioned in 50C. This is very interesting, but a lot of people, the department is always says that deemed consideration is the amount to be considered under 54F. It is wrong. You have to be only actual considered received should be considered in 54F, not 50, only for 50C you have to consider. Next, in the case of an apartment, we have a lot of issue in the apartment. You book on one date and enter into an agreement. And they say, okay, you give me a possession by in another one month or 1 year or 15 months, 18 months, like that, you will enter it. Now they say that the purpose of this transfer definition, 242A, 36 months, now is a 24 months. Booking rate, the owner of a apartment book prospect is entitled for the period of holding from the agreement to sell executed. Maybe you have taken possession later, but agreement to sell maybe 1 year or 2 years back. That is a period you have to count for the purpose of long term or short term. That date you have to count, not the subsequent. That is what the important thing for the purpose of deciding long term or capital. Period of holding of the property where it was originally allotted as the leasehold right, but later is converted to freehold property. They say that what is the date on which you got the leasehold right? That is the date you have to count. There is some contrary decision in the various high court, but this decision says that from leasehold right when you got from the date, how many months you are holding this property, not from the when you are converted into freehold property. Take for example, in case of a the authorities like a Bangalore Development Authority, what they will do is Bangalore Development, first 10 years they'll give the leasehold right. After 10 years over, they'll say you enter into a sale date, then from that is updated. For this purpose, now they say when you sell the property in the 11th year, 10th year you have executed absolute deed, where the property is less than 12 months from the date of freehold property you are holding. Therefore, for that purpose, they said Dr. Modi case in Karnataka High Court, from the leasehold right when you have this one, that is the date you have to consider the purpose of holding period decision, not the freehold property. This is also same decision, same way it is decided. This is very interesting. For the purpose of valuation under 50C, land and building cannot be treated as a separate asset, and thus computation of capital gain can be bifurcated. Their joint valuation to be adopted. In this case, very interesting. Suppose I am having a land as well as building, a constructed building. The purpose of 50C, whether I have to value the land separately or building separately. Take for example, I value the land as per the SR value and what consideration mentioned sale deed tallies. There is no variation. SR value, what is the government authorities value, guidelines value, and my consideration mentioned sale deed tallies. Both are equal. My value consideration is more. In respect of construction of property, there is a construction as per the consideration mentioned in the building. I say 50 lakhs. Maybe yes, how much? But valuation, if you do it, suppose for the purpose of the valuation under 55, it is suppose 30 lakhs. Now they say for the purpose, suppose you have mentioned in the agreement when sale of land and building together, if you say mentioned, they you say both together is suppose X figure, that figure should be more than the stamp duty value fixed for both together. That's what. Suppose if a sale deed is separately mentioned, this case law is not applicable, then you can overcome that. Land value you can separately mention, that is equal to the SR value. Building, you can say this is a valuation I have done, this is only 2,000 square feet constructed area. You mentioned this is the what. Both together I'm paying consideration is so much. But under 194A, you calculate 1% of the total value consideration. For the purpose of 50C, land separate, building separate, but provided you have to mention in the sale deed. But in the sale deed, you are not given the breakup, then this case law is applicable. Then both together you have to value and consider the 50C figures for the purpose of taxability or for the purpose of stamp duty valuation. Another case I told you earlier, for claiming an exemption under 5450, whether I buy an house outside India, whether eligible. In this case, he say can associate acquire a household outside India. So in this case, they say you buy outside India, you are not entitled. But earlier I told you, if you buy a house within buy a house anywhere in the world, you are entitled. But this decision says no, you have to buy only in. This is a Bangalore decision. It says you have to buy in India. If you buy outside India, you are not entitled. Anyway, it is not binding on Visakhapatnam Chartered Accountant. Therefore, you can utilize the first decision. This is very interesting. Here in the case where property was acquired in the name of the person other than associate claim the exemption. In this case, what happened is the person who sold the property is, take for example, Mr. A. And after that, he wanted to, for technical reasons, I don't want to own the property. If something happens to him that he transferring the property to this one, he told, okay, is it registered in my wife's name, Mrs. A. Now the question is whether 54 or 54F is available, because 54 says person who sold had to buy the property. New property should be owned by the person who sold the property. But in this case, is other person, whether entitled. In this case, whether he owned the house property, sold the and purchased another property in the name of his wife, the exemption under 54 shall be allowable. In this case, what they say is your investment in the new property out of the proceeds from the old property. That should be very important. Name is only technical, but the investment should be from the sale process from the old property. That is very important. You prove that you are entitled for that. I think majority of decision on in this case, one or two decision says that no, both seller who sold the property and who is buying property name should be same. Name should be same. This is what where it is a little different. This is a very interesting. In this, what happened is he sold the property and he is kept whatever the sale proceeds he utilized for some other thing. But within the time allowed, he construct another house. The income tax officer told, no, what you receive the consideration, your same thing you are not invested in the new construction or new purchase. The tribunal held that no, as long as within the time allowed, if you invest in the new house, the same amount, what is required for time exemption is fair enough. Not necessarily same money has to go there. No. That amount should be utilized. Utilized in the sense, what is the meaning is that much amount you have to utilize for the construction of a new house, not the same amount you have to utilize. What is the department contention is, suppose you receive consideration, deposit in a particular bank account. From that bank account, you issue the check for purchasing property or constructing a property. Then only you fulfill the conditions of 54 and 54F. But court tribunal held that no, within the period allowed under the act, if you buy another property from whether borrowed funds or any, but you have to this, then you are entitled for exemption. That is what they wanted to demonstrate, that what is the meaning of money utilized. Money utilized is you have to utilize the money to the extent of sale, then you are entitled for it. This is not much important. Loss in illegal business cannot be set up by anything. Profits of legal cannot. This is not much relevant to the capital gain anyhow. Standing trees are cut and sold constitute a capital asset, giving rise to capital gains. Sir, in this case, you have to very clearly understand the standing trees in a agriculture land, standing trees in a non-agricultural land. I am giving example to try to understand that. Suppose you have a standing trees. Take example, you have a big plantation, coffee plant. In that you have a standing tree. The case law says standing tree is also a capital asset, is liable for tax. This is a decision. But standing tree in an agricultural land is exempt from taxes. Whether sale of agriculture produce or a sale of agricultural land is definitely it's not liable for capital gain tax. But what are the standing tree in the agricultural land? Some shade trees or side-by trees, all the things is standing trees suppose cut and sell in an agricultural land, whether liable for tax or not. It is a big question mark, friends. I'll leave it to you. Please take a call. But this decision, only the standing trees in a coffee plantation or a standing trees in non-agricultural land is liable for capital gain. Standing trees in agricultural land, in my personal view, is not liable for agriculture because this is also an agriculture activity. What are the incidental agriculture activities? What a standing tree or a shade trees or a side trees which cut and realize some small amount. It is also an agriculture income, not liable for tax. That's what I explained in agricultural land. In this case, one associate booked a semi-finished flat with a builder. He told you construct only 4 walls, give it to me, other things I'll do it, tiling, inside kitchen, inside bathrooms, inside bedroom, all these things I'll do it. It means civil work or woodwork work, all these things I'll do it. He give you only shells. Okay, in this case, what happened? The unfinished, semi-finished plot was given to the builder as agreed to give, and he constructed unfinished shells of the flat which was to be finished by the assessee on its own make. Only he wanted to do it on his own make. It is eligible was to be considered as a case of construction of flat and not purchase of flat. Further, since the construction was completed within 3 years and sale of original asset, which was accepted by the assessing officer, exemption under 54 is granted to the assessee. This is what happened is within 3 years they constructed a flat, semi-finished flat was ready, but inside marble, wood finishing, all these instituted after 3 years. Therefore, tribunal held that no, you have finished the construction within 3 years. Furnishing, giving a good look to the house, are that taken after 3 years, but maybe take another 1 year, you are entitled for exemption. 54 is still eligible for you. You are not denied any exemption because you have constructed a house within 3 years. Living house, or it is ready, you have to go and occupy. We usually say within 3 years, you do some Gro-Prasham card, give me proof of that Gro-Prasham. That is enough for you to claim the exemption. It is okay. But your agreement says you have to give a semi-finish, he has given semi-finish. Only I have to give a good look to the flat for which I spent some marble or wood or something like that. Is all extra. Even if it is done after 3 years, still you are entitled. That's what the decision of this. Correct. Sir, in this case, assessee claiming exemption under 54, he claimed 54F by mistake. Just ignorance, he has claimed under 54F instead of 54. Here is the tribunal says that the assessee has done mistake. You are an assessing officer, you have to compute under the correct head. Correct section, you have to give the exemption. If you are assessing entitled for 54, please give the 54. Even you have claimed 54, you have to proceed, which is correct, you have to allow. This is the decision which says that you have to, assessing officer has to compute the correct exemption under which section, 54 or 54F. Give the exemption under 54. By assessing mistake 54.4, you cannot say, no, 54, these are the conditions, you are not fulfilled, you are not entitled. But if you fulfill the conditions specified under 54, you have to give the deduction under 54. Then you should not deny by technical reason saying that under the in a return income, you say deduction under 54F, but 54F, but I'm entitled for 54, you should allow under 54. This is the decision which is binding on the assessee. You have to compute the income as per the correct law. I told you earlier, person who sell the property had to buy the property. The name should be same. In this case, assessee sold the property and he is purchased the property in the name of the married daughter. Married or unmarried son, married son, I don't know. It is a different person. This court said, this tribunal said that this is Andhra Pradesh tribunal, in which they said that no, if you are buying, a person who sold should buy the property. In this case, is purchased by his daughter, married daughter, she is not entitled for the exemption under 54 or 54F. This is the thing. They will be careful. One is in favor, another is against. This is Andhra Pradesh is against the assessee. Be careful, you are not entitled to claim. Sir, reference to the valuation officer is a must when assessee objected to the valuation. Suppose stamp duty valuation as per 50C, something figure is more than the consideration, and you objected to the appropriate authority, you are going for an appeal and other thing. That time is an obligation on part of the officer to refer to the valuation officer for revalue this asset under 55A. This is a must, you have to do it. He cannot keep quiet. Once it is referred, the stamp duty valuation is wrong, I filed an appropriate appeal before the competent authorities under the state law. Then the assessing officer, he has to say that yes, under section 55, I'll report to the valuation officer and he has to report to the valuation. Whatever the valuation officer gives, that you have to adopt. This is a must you have to follow. But we will not insist. In case of our practice, one valuation we say, sir, kindly see what should be done. Finally, whatever that. But in this case, if he has not refer to the valuation, it is a technical breach, then this assessment is bad in law. This is a very interesting. Section 50C is not applicable to a transfer of immovable property through company, by the company through shares, transfer of shares. Suppose you are buying a company shares, because you are buying company shares, you are entitled for, suppose you buy 1,000 shares, you are entitled for 1,000 square feet of area in a apartment. That is the arrangement in that company. Suppose I buy 1,000 shares and I get one immovable property, my interest, my property. That case, section 50C is not applicable. Section 50C is applicable only for a immovable property. What I'm buying is a shares, therefore this section is not applicable. Even though you are acquiring an immovable property by indirect way, but 50C is not applicable. As you know, for the purpose of section 54 exemption or 54 exemption, you should sell the residential house. 54 say you sell the residential house, you buy another house, you are entitled for deduction. In this example, friends, the owner, along with his brothers, family member, entered into development agreement to the developer. Before ending of developer agreement, the existing building they are demolished. It means it's a vacant site. And now you cannot claim 54 because what you are selling is a vacant site. You are not entitled for 54. 54. This because 54, this should be a house that you are transferring, then you are entitled for 54. In this case, what you are transferring, because you are demolishing the existing house, therefore what you are transferring is a vacant site. As per the joint tenant agreement, it is you will not entitled for 54 exemption. This is what they are. Sir, in this case, mostly Chartered Accountant has advised to him. He sold the property and he wanted to buy another one property, but he purchased a flat, vacant site. Auditor advised him, hey, you should do a living place. To claim exemption, you have to buy, sold the property, you have to buy another residential unit to buy, but to claim the exemption. What he did is a vacant site, he constructed a rivery with a small bricks, mud, there is no compound wall, nothing. He constructed a house, no toilet, no electricity, no water charge, nothing. He constructed a house and said that I construct a house, therefore I am entitled for deduction. Court said no. The house should be capable of residential use. In this case, what you have constructed a brick with mud, there is no toilet, nothing. Therefore, you cannot live in this house. It is not a residential unit. Therefore, you are not entitled for the exemption under 54. That is what this. In case of block of assets, section 50 deals with the block of assets. But all the, for the purpose of 50 may mean assets of all the units associated having the same rate is called block of assets. Take for example, one company having 3-4 divisions. In each division, they have various type of assets which are different rate of depreciation. The purpose of block of assets under the Income Tax Act 50, all the units, all the rates, what are the prescribed rate, you have to decide what rate that will be treated as a block of asset for the purpose of claiming depreciation. What do you know? Depreciable asset also is liable for capital tax. For that purpose, they said that all the units together that to be treated, not each unit was. In a case where assessor is borrowed some funds for buying a property, and he claimed that interest paid on this capital as a cost of acquisition. Fortunately, this court held that cost of the interest on borrowed capital is as a cost, you are entitled for deduction. But it is a big question mark. Don't claim this is a Karnataka High Court decision. But facts at the time, whatever the thing, and this is a 2010 case, Arira Motors, they said that yes, you can claim the borrowed capital as a cost of deduction. This is what the deductible as a cost of acquisition. But if we see the section 36, see the borrowing cost as per the accounting standard, They say very clearly borrowing cost, whatever the cost up to the date of asset to use, you can claim as a, you can add it to the cost of the building or a cost of an asset. That is the thing. That is only for accounting standard requirement. That is only for the company law requirement. But when it comes to income tax, once you borrow the capital and construct it, subsequently you started using that, and whatever the interest you capitalize later or up to the date of this one, whether it is allowable or not. This decision says is allowable as a cost of acquisition, you are entitled for deduction. This is a set off of the capital, long-term capital gain depreciabilities. Yes, they said 74(1), you are entitled to set off. That is what the set off of this I already explained in my presentation. This is an example of. In this case, what happened is assessee wanted to invest in 54 EC bonds. Within 6 months, he had to invest. That time, there is nowhere in India bonds are available. You know, we have faced this situation in the 1 or 2 years back. Bonds should be available to invest under 54 EC. In this case, bonds are not available. Therefore, assessee could not invest within 6 months. Maybe after some time, bonds are available. Immediately, he invested. This tribunal said that even though you invested after 6 months, still you are entitled for 54 EC exemption, because when you wanted to invest, your intention want to invest, the bonds are not available. You are available subsequently, you are entitled for. This is a decision of Mumbai tribunal. We say that you are invested immediately after the available bond, then you are entitled for exemption. One more decision, it says that 54 exemption you want to claim. Sell one property, invest in another property. Assessee name is a must. Assessee only should buy, not somebody's name is not permitted. This means he should invest and sale proceed and claim the deduction, not the others. Even daughter or a wife is a big process. Therefore, we suggest always buy the property. You only invest in new property. After 1 year, 2 years, you give it to your family or will to your family, but don't do without buying. Purchase, buy, claim exemption, then subsequently sell it. That is what you have to do it in this type of, otherwise you will invite some problems. In this case, I told you already, for due date for keeping the amount in a specific bank accounts, whether 139 time limit or 139.4. But usually we say the due date means due date specified under 139. That's what is it. Here says 139.1 or 139.4. You know, there's a lot of difference between 139.1 is a due date, maybe 31st July or 30th September, or now the due date is for the relevant year is August or September or October or now. This is a due date. But in this case, they say 139.4 due date for filing your revised return. What is the due date? Or is eligible for this, not the first due date. Or what are the due date, end due date for filing revised return? What are the due date? Maybe year end of the previous year, next previous year. Then still you are entitled for this. This is what the Karnataka High Court held in the case of Fatima Bai, held that this is the 139.4 is the due date for this. Sir, these are all only when you have a problem you have to think. But don't advise the assessee that 139.1, no, the deposit anytime, no, don't invite problems. But what happens if you already not done because of any reasons, you are not aware, assessee was not aware, he comes later, then you take a clue under this saying that 139.4 is the due date for claiming this exemption 54 year, otherwise I'm entitled. Sir, in this case, what happened is he entered into an agreement in the 1 year, but possession was given the later. Therefore, this law says even though you enter into an agreement, but possession given the subsequently, so the transfer definition says when you enter the possession, that is the due date, that is the date, that is the year in which you have to pay capital. This means when you enter the possession, that is the year in which you have to pay capital tax. Here is only one example I have taken in case of some slum sale. Slum sale means you are not selling the assets and liabilities individually. You are selling the undertaking as such. Suppose you are selling one undertaking, one unit, one company, as it is slum sale, then all assets liabilities together, you will determine what is the thing. In the case where stamp duty value, liabilities are more than the value of the network. In this case, where stamp duty value for land or building and liabilities is more than the net worth of the company, net worth of the cost of acquisition of this land and building, then you have to take cost is nil. And also I told you indexation is not permitted. Then if it is whatever the cost you consider, what is the lump sum consideration received, difference is the capital gain, you have to pay capital gain tax, short-term capital gain tax, whatever the applicable tax you have to pay. The one more is where we have violated some provision. As per section 54F subclass 4, you have to keep it a specified bank account. In this case, they are not kept in a specified bank account. They violated this section. Then this says that if you violate technical violation of any section, you are not entitled for exemption. You are not entitled for exemption. This is one decision I told you, agriculture income, you have to carry an agriculture activity, then only is called agriculture income, agriculture land. In this case, capital gain on sale of an agriculture land is exempt from tax, even if there is no agriculture income that particular year. Even though there is no agriculture income, we still is in agriculture land, you are entitled for exemption. This decision already discussed. Bonds are not available, therefore you are not invested, you still are entitled for. In this case, the house is constructed in a commercial complex and assessee claimed this is a residential house and used for residential purpose, and there is no other evidence. There is no proof of the sanction by the authorities or things. It is a commercial complexes. At the fourth floor, you are converted into residential, whether it is a residential. But they say that unless you have a proof, if there is no proof, then you are not considered as a residential unit and you are not entitled for 54 or 54F exemptions. Sir, in this case, family, this is a property belongs to family. A family business means father, wife, and son. They decide to buy son's share by husband and wife. They decided, yes, we'll pay the amount to the son. We'll take the share, his share also for the purpose of the. Then court held that yes, you can take it. Whatever the amount paid to your son will be treated as a cost of the property. Even though originally you are owner of full property, but subsequent to release the his share of the son's share of the right, you have paid some amount. That is also a cost of acquisition. You are entitled for deduction. Sorry. Friends, I thought I do not bore you. Already exactly I reached 8 o'clock. Now I thought these are the examples which gives you some highlight on the issues involving the capital gain. Therefore, I shared all these things. Simply presenting the capital gain by whatever there in the section. I think it will not go inside the chart account brain. Always chart accountant want examples, issues, complications, confusions. Okay. Therefore, I created these problems and I shared with you, all of you. Friends, if you have any questions or anybody you want to add or delete, anything you want to do, please do it. You have a time subject to organizer's permission. No problem. My side is no problem. I'm ready to sit in another 15-20 minutes. And any question is that I'll take up the question. I'll try to give my views. Otherwise, I want to thank each one of you for the patient hearing throughout for 3 hours. That too, COVID period. So many problems we have faced, and also so many due dates which are in the head for us to file the returns. With this, you are done. I am very grateful to all of you. Thank you very much. I'll see the next opportunity. Whenever possible, I want to come to Visakhapatnam, collect my dues. Whatever my dues is there in the sweet collection, I'll collect it. I want to thank.
It's a pleasure, sir. It's a pleasure, sir.
Thank you, sir. I am very thankful to Sharma for remembering me and inviting me. When he called, I know he always, Sharma calls me, but only says, sir, you have to come. He will not, request is not there. He is only direction. and I take it in a very positive way. Thank you, Sharma, for inviting me and giving an opportunity to share my views on the cabinet. And also my friend, Mr. Sandeep, also join me in thanking all of you for giving this wonderful opportunity. Thank you very much. If any question is there, I'll take. Otherwise, thank you.
Yeah, thank you very much, Venkatesh Garu and Sandeep Garu, for your excellent deliberations and
Thank you, sir.
detailed explanation about the issues in capital gains. So there is one question in the chat box. So an SSC is seller has incurred stamp duty for the transfer of his property. Usually buyer will be paying the stamp duty, but here the seller paid the stamp duty. Can he claim this stamp duty paid as a deduction while calculating capital gains?
1 minute. Sir, actually, you told there is usually buyer will incur the stamp duty and registration charge, generally. But in the sale deed, if you have mentioned, saying that stamp duty and registration charge were borne by the seller, there will be sale deed, it should be there. In the sale deed, if you have mentioned that the stamp duty and registration charges for transfer of this property is borne by the seller, then what you can do is sale consideration minus this expenditure, stamp duty and registration charge, the net consideration you arrive, and then claim the cost of acquisition, cost of procurement. But if you are not there in the agreement, if it is not there in the agreement, it is not there in the agreement, I doubtful is very difficult, because throughout the at least your state or our state, always the cost of the stamp duty or registration charge borne by the buyer. You want to prove that this is not done, there should be some agreement or sale deed, there is some mention for the sharing of the stamp duty and registration charge, or they exclusively say that all the stamp duty and registration should be borne by the seller. Then you can claim the deduction. I know, to avoid all this SR value and other thing, what happened in SR value is one figure, you want to fix that figure, you don't want to go for under valuation for any authorities. Then you say that, okay, I'll bear the stamp duty, I'll bear the, then kindly mention in the sale deed. If you are not mentioned, I doubt you can claim that. What is that? Yes, sir.
Sir, there is another question from Sridhar. Sir, Sridhar, sir, you are anyway there.
Yeah.
You can directly ask the speaker.
Sir, good evening, sir.
Good evening, sir. Good evening.
There is one SSA for me. It's my own case actually. I have paid around 50 lakhs to a builder in 2014. There is no agreement or any no document as such, since he is very close relative of mine. This contract is going on. This year it is supposed to be completed, and he will be transferring say 1,500 SFT of the built-up area. Can the payments made by me be adjusted against the sale consideration?
No, one minute. You have purchased the property, correct, from developer?
Yeah. I have paid money without entering into any agreement. No agreement from the developer.
No, you are very generous. I'm very happy that you are very generous in without agreement. You have paid 50 lakhs. I'm very, very happy that chart accountant without agreement, you have paid 50 lakhs to maybe your close friend. Very good. You have purchased the property and you have paid 50 lakhs advance without any agreement. What is the issue now? What is the issue now?
This year, the property will be registered in my name.
You will be registered today. You will be registered.
Yeah.
Okay. This year will be registered in your name. Fine, sir.
Yeah. In that case, the proceeds, the transfers into 2014, can that be adjusted as sale consideration for this property?
No, sir. You are in a position to prove by a simple letter saying that he has agreed to allot me so and so flat.
Yeah.
And say this is a consideration you have to pay.
Yeah.
And you have paid all by check.
Yeah.
You have a proof that you have paid all by check.
All by transfers.
Then on the letter from the builder saying that you allotted this flat and you are paying so much you have to pay.
Okay.
That allotment letter itself is an agreement.
Okay.
Not necessarily a stamp paper. The allotment letter itself is the agreement. Okay. Based on that, you can count it is more than 3 years old, because the agreement date is very important. Okay. And today you are registering is only formality of registration. Okay. It is no relevance at all. You can claim as a long-term asset and entitled for what are the exemption you want to claim, you can claim. But the one letter evidence is required. Evidence is one is bank payment.
Okay.
To the developer.
Yeah.
And the next is one letter from him saying that he has allotted so and so land to you, so and so apartment to you.
On the date of transfer. On the date of transfer.
On the date of agreement, what you have proposed to pay the amount, no?
Yeah,
Before that, you enter into one letter. Just letter, I am accepting your this one for buying property. You also acknowledge,
okay,
saying that this is a property agreed for X figure. I am going to pay it on various terms and conditions. One letter. The allotment itself is a constitution agreement. That itself enough for you to claim all the benefits all over the act.
okay, sir. So in the hypothetical case, like, can the builder accumulate any nominal interest on this amount that I have transferred to him as the cost of borrowing? Sir?
No, sir. Now you want to claim as a deduction, huh?
Yeah, from the builder point,
The first question you asked is your question.
Yeah,
Second question you are asking is builder question, correct?
builder questions. Yes, sir.
Ah.
Yes, sir.
Whether there is a benefit to you. Suppose builder agrees to give you interest.
Yeah.
You pay tax to the government. He
Okay.
deduct tax as source. I presume that is a company. They deduct tax as source. What are they? It is a loan transaction. It is not
Yes,
an
sir.
advance for the purchase of property. It is a loan transaction.
Loan
It
transaction.
is a company. The builder is a
individual.
company, or it is individual, or it is a partnership.
It's
Huh?
individuals. Individuals.
It is individual, no problem.
Yeah.
And is no violation of any company law, because here is the thing, what you are given is for booking advance, correct? What
Yes,
you are
sir.
given a substantial advance, because he is a friend, you have given the advance. But
Yes.
you cannot say in the second breath, saying that no, this is the advance, he is paying interest. Why you should pay interest when you are given advance? This
Okay.
goes against your understanding. Therefore,
Okay.
paying interest is, I think you lose the title that you are not given the advance. This is only a loan transaction. Whatever
Okay.
interest you get, it is a loan transaction.
Okay.
I think my suggestion is give 50 lakhs, reduce your interest, whatever you get benefit in your cost of flat, and
Yeah.
take it for the lesser rate, because you have paid the advance in the beginning or earlier period. You're entitled.
Thank you very much, sir. Thank you, sir.
Thank you. Thank you.
Sir,
Another
Hello.
question in the chat box.
Ah,
In case of joint development, landowner portion is taxable at what value?
I'll read. So in case of land, JDA are a very complicated transaction. But I'll take a simple transaction where JDA entered by the developer or owner. Owner handovers the land, and the developer constructs the property. In the year of handing over the land to developer for construction, you have to take the value of the, or the portion of the land which is handing over to the developer. He is handing over full land, out of which 50%, take for example 50-50 sharing, 50% of the land which I am handing over to developer, he is going to be belongs to him for his construction. Another 50% land which is constructing, that property will come to me. Therefore, on 50% of the land, on the date of handing over possession, on the date of entering JD agreement, depends upon the facts. When you are handing over, you have to see what is the fair market value of the land. That may be SR value. Fair market value is the best is what is the SR value of that land. Or suppose you have 10,000 square feet of area, if you are transferring 50% as per the agreed terms, 5,000 square feet, what is the fair market value? That is the consideration you are presumed to receive. Now that is not applicable, because now the decision is this all capital can arise only when the possession certificate is given by a competent authority. Therefore, you have to wait for that. That is the provision now. Anyhow, for the purpose of this, fair market value on the date of transfer of property to the developer. That is the fair market value you have to take.
Sir, and the same question. Now, sir, you are telling that in the value is we have to take the fair market value at the date of JD agreement whenever you are transferring the property to the land to the joint developer.
Correct.
But it is taxable at the time of in the possession taking at the completion.
Correct.
So that 50% that we have to offer for this one, the fair market value as per the now, it is the land we have given in the name of, you have given in case of measurement is cents or the kind of thing. When you are taking back, you are getting the possession in the square feet.
Correct.
The fair value has to be taken at the fair value of SR value of square feet at the date of JD transfer to the owner. Am I
Correct.
right?
You have to convert like that. Sorry, whatever the final figure is, maybe in square feet or in cent, You convert, there is only mathematical and calculator is involved. You
But
convert
fair
it and
value is- but fair
tell-
value is on the date of transfer the land to the developer.
handing over the possession to the developer.
Yes, okay.
Agreement is later or the sale deed is later. When you handing over the possession as per JD, you say that you are within 6 months you have to hand over. Within 6 months you have to complete these formalities. After the formality is over, you have to hand over. That date it will be the formal date of handing over the possession to the developer. That is the date on which you have to find out the fair market value of that land you are going to transfer, 50% area or whatever the area agreed. That you have to fair market value, you have to compute and pay capital tax at the time of obtaining a occupation certificate from the competent authorities.
So it says that if the developer is pays the he sells the his portion of the flat at different value.
Sir, that is a no relevance to me. Sir, the developer sells one plot at 4,000 square feet, another plot at 6,000 rupees. You cannot take that. You have to take a fair market value. Fair market value on the date of transfer. That value you have to take it. Because in any construction industry, this will be thing where one plot we sell at one rate, another plot at one rate. You cannot take the latest or the
Highest rate.
which is the higher rate you cannot adopt. You take the normal average rate or something like you would find out and take that rate as the rate average fair market value for the purpose of this taxation.
Sir,
Okay,
further
for
to this
consent.
query, sir, further to this query, if the developer fails to complete the venture by the appointed date as per the development agreement, and consequently occupant certificate or the substantial construction of the building is not completed, in that case, when the capital gains liability arises.
Sir, I think you are missing a very important point. Competent authority will not give occupation certificate unless the building is now ready. You say building is not complete, how can you get occupation certificate?
That's what, sir.
No, I'm telling occupation certificate is not possible to get without the completion of the building.
Yes, sir.
Competent authority will give permission only when the building is ready for occupation.
Yes, sir.
Then if when the building is ready for occupation, then you have to compute that. But your example you have given is occupancy certificate is obtained, but building is not completed. I think it is not possible.
No, not the question, sir. What I'm saying, in the development agreement, say from the date of the development agreement, within 12 months or 18 months, the builder has to complete the construction of the project. As you said, in the capital gains liability arises to the site landowner on the date of the completion of the transfer as per the agreement.
No, but here is now joint development agreement says you have to complete all things in 24 months. Suppose you have taken 3 years, but occupancy certificate you obtain in the 5th year, you have to pay capital tax in the 5th year, as per the latest.
Okay.
Like that. It is not the JD agreement, it will not be. JD agreement for the initial thing. But for finally, when you obtain the occupancy certificate, that year of occupancy is the liable for capital.
Sir, for period of capital gains, that is short term or long term. So when the what are the starting period date we have to consider for the JD?
Sir, first is in the hands of the owner of a land.
Mm.
In the hands of the owner of land, whether he is holding more than 24 months or less than 24, that you decide on the date of possession, handing or possession. If it is holding more than 24 months, it is a long term in the hands of the owner. When you come to the thing, suppose I take the property, developer or owner will take the property once occupation over and immediately I'll sell, then is a short term capital. But I'm holding for 24 months, after that I'll sell, then is a long term. Like that, you have to, period of holding, you have to decide.
Thank you, sir.
Thank you.
Another question in the chat box from Vasiri to Gawan Prasad Garu. In regard to joint development agreement, section 45(5)(a) and 49(7) exemption is there until project completion. In case 100 flats are receivable, the moment he sells one flat, as he loses the claim for exemption, and is he liable to pay the capital gain on the land and profit on the flats under construction?
No, here is, he constructed a block of apartments. As per the new provision under 45(5)(a) and 45 this one, 4, they're very clear that you have to pay capital tax only when you receive the occupancy certificate from a competent authority. But your example, you got 100 units, but you receive the occupancy certificate how many units? You receive for everything now. Occupancy certificate.
Usually occupancy certificate will be for all, na, sir. Not for
Correct.
individual flat, no?
All you got. But
project.
what is your question next? What is your facts he told? Next is he sold the property.
Yes, sir. We sold one flat.
Immediately after obtaining the possession.
Yeah.
By the is the owner of the or developer. If he is a developer, it is a business profit. If he is a developer, you have to see period of holding, whether more than 24 months or less than 24 months. So it is more than 24.
Sir, sorry to interrupt. Occupancy certificate not received by the time when he sells one flat.
You cannot sell, sir. Now it is not possible to sell without occupancy certificate. Then say what I'm doing, you can sell it. But for the purpose of claiming exemption and other things, you are not entitled for. You have to pay full tax at 30% rate. Not long-term capital gain short, you have to pay business profit. If you want to pay the person who is buying without occupancy certificate or not received occupancy certificate, you can sell. But it is a normal rate of tax, not the capital gain. It will not be. Possession certificate is very important. We are not obtaining possession certificate is, in my opinion, is not a thing, and it will be liable for business receipt and liable for business. Capital gain means these are the conditions you have to fulfill. Obtaining possession certificate, holding period, all the you have to fulfill. Then only you are entitled for. In case of a developer, in his hands of a developer, always is a business profit. It is not a capital gain at any point of time. Whether he holding for 10 years or it should be a business profit. But in case of an owner, that will be holding period is very important to decide capital gain or a business. There is no question.
Members, any more queries?
Can I speak, sir?
Yeah, please.
Murli garu,
Sir.
I'm not clear about that. Supposing the landowner sells only one flat, so
Yes,
he
sir.
loses the exemption and he has to pay tax on the entire land. That is clear.
Sir, I think which exemption is available to the land developer. You tell me, sir. No, I think you have confused the full thing. Sir,
No,
here
no,
is
not
a
developer.
Sir, the question is with regard to landlord.
Sir, landlord, sir, I'll tell you 1 minute. Landlord, when handing over the possession, he'll be pay capital gain tax on the land transferred. Whatever the land portion is given to the developer, he have to pay capital gain tax on the land. That is the independent computation. It is a long term. Here there is no possession certificate. Possession is there. But to sell the apartment, possession certificate is a must. Possession occupancy certificate is a must. Once you give the occupancy certificate, then it starts. But your example is land is a separate computation. It is fine. But when it comes to a landowner portion of the apartment he receives, and he cannot sell before the occupancy certificate received from the competent authorities. Suppose sell it, it is a business profit. It cannot be treated as a capital because he is not holding more than that. The capital asset becomes only when you receive the occupancy certificate from the competent authorities. Up to that, it cannot be treated as a capital asset. After receiving that, whether your holding period is more than 24 months or less than 24 months to determine it. But in the case of developer, always is a business asset. It will be liable for business profit, not capital gain. This is the two.
Sir, Venkatesh garu, here, excuse me, sir. Here the question is landowner is not having any money to pay the land tax. Only has handed over the land. But without having any money, how can he pay the tax? That is the question.
Sir, why you are taking capital gain? I'm telling you in some cases, sir, I don't have money to pay income tax. Sir. What I should do? Now we'll discuss that point, sir, as a consultant. Sir, I don't have money to pay capital tax, but you have sold the property, but you have to make an arrangement.
Yeah.
See that whatever is the statutory liability of paying capital tax, you have to collect some portion in money from the developer to pay capital tax. You have to plan in such a way that, so I don't have money, then there is no exemption under the Income Tax Act. If you don't have money, then so many people say that I don't have money, I will not pay capital tax, I will not pay income tax, I will not pay TDS, I will not pay GST. but that exemption is not available. It is your obligation, statutory obligation, your obligation. You have to discharge within the time allowed under the Act. You
Yes.
cannot escape saying that I don't have money. No.
So the main question is of him, I think I understood like that.
No. Sir, the question. Sir, take for example, sir. The law says advance tax I have to pay 15% by 15 June, another 30% by 15 September, another 30 by December, remaining amount by 15 March. Tell me, sir, by 15th June, how is possible for me to estimate my profit is so much for the current year? If I have not paid 15%, I am liable for 232%. Is it fair? I don't have income at all. During the first 6 months, I don't have income. My balance sheet or my profit says nil. I am having a loss. Remaining 6 months, I made a profit. But I am entitled, I am liable for 234C. At the year end, I am liable to pay 234B. All is are there. But in the Income Tax Act, I want to tell you, it is a no logic, no excuse.
అది రేపు
Yeah.
ప్రోగ్రామ్.
You have to pay tax, you have to pay tax. There's no exemption.
Okay, sir. Thank you.
Thank you, sir. Anything you want to add? You're ready to. ಸುಮ್ಮನೆ ತಮಾಷೆ ಹೇಳಿದ್ದಾರೆ ಹೊಸ ಹುಡುಗ ಮದುವೆ ಆಗಿದ್ದಾರೆ.
So thank you very much, Venkatesh Garu, for your valuable time.
Thank you very much, sir. Thank you very much.
3.5 hours. Really, it's a great opportunity for us
Thank you, sir.
to learn many things from you. And
Thank
now I
you.
request the Secretary of our branch here, Prashant Kumar, to propose vote of thanks.
Respected Chairman C.A. Murali Garu, Land Speaker, Senior Member C.A. D.R. Venkatesh Garu, another Speaker C.A. Sandeep Garu, and Senior Members and other dignitaries. Good evening to all.
Good evening.
I am privileged to propose vote of thanks for the session on my behalf and behalf of the Visakhapatnam branch members. Sir, C.A. D.R. Venkatesh Garu and C.A. Sandeep Garu, I am conveying my heartfelt gratitude for accepting our invitation and explaining and sharing your knowledge and thoughts about the capital gain critical issues. Thank you, sir. Sir, your deliberations on capital gain critical issues with decided case laws are excellent and exhaustively covered, sir. Your deliberations on critical issues like transfer of agricultural land and its implications, transfer of compulsory acquisition, interest on borrowing capital, and matters of exemptions are presented in a wonderful manner, sir. I strongly believe that all the members joined in the webinar got benefited by your wonderful session. Thank you very much, sir.
Thank you.
C.A. Sandeep Garu, he is also like his guru, very nicely, pleasantly presented his deliberations on NRI taxation issues with respect to the capital gains. C.A. Sandeep Garu, thank you very much for your deliberations. Like 1+1 offer, we requested our C.A. Sandeep Garu for this one, and he, with the affection on the Visakhapatnam branch, he offered his C.A. Sandeep Garu speeches to us, all of us also. Thank you very much, sir. Dear members, tomorrow we will have branches celebrating August 15th celebrations, flag hosting by 9 o'clock, and it is followed by the breakfast and other CSR activities also there. I request all the members, please join with us and make it grand success, sir. Thank you, one and all. Thank you.
Sir, I want to wish all
Thank
of
you,
you.
Venkatesh Garu.
Thank you,
Yeah.
sir. I wish you all the Visakhapatnam branch and participant for the very, very 75th Independence Day, and also what are the program is lined up for tomorrow. All will be success. I wish all the members will enjoy the Independence Day tomorrow with their family and come this one. Thank you very much. Thank you.
Thank you very much, sir. Thank you, and same to you, sir. Wish you the same. Yeah, thank you.
Huh?